Good morning. It is 9 a.m. here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Diane King Hall this morning. Here are three things that you need to know to start off your day. Stock futures lower after a down day on Wall Street. The focus very much on minutes from the Fed's last meeting. The report shows that officials were privately divided on how to progress with rate policy despite a public show of unity. Investor bets on a hike at the next meeting are now edging close to the 90% mark. The key question remains, how many more can we expect this year? Attention will swiftly turn to the jobs market with tomorrow's payroll report. Expectations are for an increase of 225,000 during June. And it's been labeled as an existential threat to Twitter. Meta has officially unveiled its microblogging service, Threads, in what is being viewed as the most legitimate rival to Elon Musk's troubled social media site yet. A companion to Instagram, Threads will allow for real-time public conversations. Facebook founder Mark Zuckerberg says the app had 10 million signups within 7 hours of its launch. The billionaire, acknowledging the blatant similarities in user experiences between Threads and Twitter, posted his first tweet in 11 years, a profound image of Spider-Man pointing at Spider-Man. And trying to fix the U.S.-China relationship again. Treasury Secretary Janet Yellen is in Beijing today as she looks to repair frayed ties between the world's two biggest economies. Her trip comes at a delicate time. China imposed restrictions this week on two metals seen as crucial to the global tech industry. It also coincides with a weakening macro backdrop. China's economy continues to cause concern for investors. Hong Kong-listed stocks just suffered their worst day since January.
Now, let's get back to Meta. It's taking its biggest swing at Twitter yet. Its new platform, Threads, launched to the public last night. The platform is text-based with a 500-character limit. It looks similar to Twitter with some of the same features, but under different management, of course. CEO Mark Zuckerberg bragged on the site this morning that it already has 10 million signups in just 7 hours. It still has ways to go to catch up to Twitter. How fast could it get there? Joining us now on this is Yahoo Finance's Dan Howley. So, Dan, I was one of the people, as I'm sure you were, who signed up last night. Where do we go next?
Yeah, Diane. I mean, if you're, you've signed up, you've obviously then been getting the nonstop pings for people that are following you back and people that you're following. Basically, you sign up for Threads, you connect your Instagram account. So I think the big benefit here is that you're not starting from scratch when it comes to followers, as well as people you're following. You get essentially what you have on Instagram, and then you can add from there. And that's a boon for this app compared to other Twitter competitors like Mastodon or Blue Sky, because you're starting from scratch in a lot of those instances. So this has a built-in advantage right there. The fact that they're offering 500-character limit, videos up to 5 minutes in length, images, obviously, it just shows that they have the technology and the capability here to really compete with Twitter. I mean, now that, we have this kind of capability with Threads, you have to wonder what this does mean for Elon Musk's site. I mean, it doesn't bode well, especially at a time where people are, leaving Twitter. Elon Musk had introduced that limit on tweets and being able to view tweets. And so this is something that they're going to have to grapple with and kind of, develop themselves out of. At this point, it's not clear whether or not Threads will eventually take down Twitter, if people would leave Twitter for Threads. The big deal with a kind of site like this, and as I'm sure people have brought up before, is that the people that use it are what makes it interesting. It's not that the app itself. Twitter is not a great app, right? It's who you follow on there. And so if those people do end up flocking to Threads, the big name, stars, athletes, journalists, politicians, if they move over to Threads and that becomes the place where they're having these conversations, then Twitter really does have a huge problem on its hands. But as it stands, Twitter is still the place where people go for that. But with 10 million signups in 7 hours, it's looking more and more like Threads might be that real threat that Twitter fears.
Dan, Great reporting, and there's so much more to still come as I'm getting some of the pings too throughout this morning here as I just joined. I was a little later to Diane to the game.
I joined last night. I mean, I should have been asleep. I was going to bed and I was like, and I saw a news alert that it had come out early because it was supposed to come out today. So I was like, let me sign up and see what this is all about. So I did, and I turned off notifications though, because that's actually what I do with social media, because you won't sleep if you keep getting pinged, this, that, and the other, So I know that it said that there are similarities to Twitter, but it does seem like a more clean user interface to me compared to Twitter.
Similarities is very generous of any of us who are having these conversations. It is essentially the same thing here. Look at it. I mean, the entirety of how this is constructed, the UX as of right now. Sure. Fair. But so for right now, let's also kind of take a big step back and remember why Meta is doing this too. So Meta, who's already got Messenger, who's already got Instagram, who's already got Facebook underneath of its helm, and now needing to once again try to mimic the features of another social media website, which is that this is not the first time that they've done that. They've done this with Snapchat. They've done this with Periscope, launching Facebook Live even after Periscope was acquired. They've done this with launching Reels to try and combat a lot of the flow of users into TikTok as well. And so all of these things considered, Meta has continued to, and even with the larger kind of video rollout within Facebook proper, they had been trying to take on YouTube to a certain extent as well. And so all of that considered, Meta has found a way time and time again to successfully, in some cases, mimic in order to make sure that they're able to monetize and perhaps unlock a next leg of growth. It remains to be seen whether this one will be successful, but at least on outset right now, in the figures of Mark Zuckerberg's sharing that have come to light, there is at least a flow of some of the early adopters that are making their way over to Threads at a time where there is a larger disgruntled nature with Twitter, a company that is no longer publicly traded, so we don't have that kind of quarterly cadence of reports that we get about how well they're doing. But there have been more of the stories of companies who are disgruntled with how much of the content, the user-generated content, is getting more vitriolic on the platform. And it begs the question of, okay, so can Meta successfully kind of make a play for some of those ad dollars? And I mean, my goodness, it's once again, can Meta do that ahead of a political season next year when they have already had those issues in the past?
Sure, they did. They had the Cambridge Analytica issues, of course, we remember that. But in terms of their, copying platforms, they do, but they often end up doing it better. I mean, like they crushed Snap. He wanted to buy Snap, remember? And that didn't happen. So he's like, fine, I'll create my own version or I'll do my own version of that. So, I like the post that you posted on there. What do we call it? A post? It's not a tweet, obviously.
My thread.
Yes,
the thread.
The thread. But it's not a thread yet. I like the name of the platform, but the cage match. I mean, I do think Zuckerberg is coming in as a heavyweight on all of these moves. So
it's a significant one. Well, the Winklevoss twins are probably somewhere saying we told y'all.
Yes, exactly.
While Meta and Twitter fight over social media, all the other big tech companies are laser focused on artificial intelligence. The tech-heavy Nasdaq has surged almost 32% as investors have piled in, afraid to miss out on the possibilities in the new tech. But how long can this rally sustain itself? Well, joining us now, we've got Michelle Schneider, who is the MarketGauge.com chief strategist. Great to have you here with us this morning, Michelle. Perhaps we start off with that very question. How long can this sustain itself?
Well, what's so interesting is that we started out this year looking at a very key moving average, which was a 23-month moving average. And really why we looked at that is that it measured a 2-year business cycle within the typical longer business cycle, right, between 6 to 8 years. And pretty much everything in Nasdaq, and certainly the big AI stocks, have cleared that, showing some level of expansion, starting actually with the semiconductor sector. But what has not been able to clear has been the small caps. And so we came in thinking if IWM, if we're going to use small caps measure through there, or you can look at S&P 600 as well, cannot show any level of expansion while everything else continues to rock and roll at some point. And we've seen this historically. The large tech looks around and says, wait a minute, nothing is catching up. And that's when you start to see selling coming in. And that's when you start to see some level of equanimity between what's happened in the large caps and what's happened in the small caps, which right now is just so divergent. It's like a rubber band. It doesn't feel sustainable.
So, Michelle, is the AI trade saturated now or not yet?
I would say at this point, well, we'll take our own portfolio as an example. We have been in, not because we were such great geniuses from a thought standpoint, but from a pure math standpoint, if you just follow the technicals, we've been in the AI space all year and very heavy in tech. So we've taken profits along the way. So the question is, would you get in here? And I think in current environment, considering what we're seeing over the last couple of days, small caps couldn't get through and now they're starting to weaken. The consumer area looked like it was going to try to get bigger in terms of the discretionary space. That's contracting. The Fed obviously looking like they're going to raise interest rates again. I would say probably not the best time to get in.
Okay, and so with that considered, where else would you be placing your attention right now?
Well, I think this correction that we've had in particularly the agricultural commodities and even some of the soft commodities like sugar are now giving an opportunity to get involved with that space because the weather has not necessarily gotten any more cooperative in terms of drought and El Nino and then floods, and which often happens after long periods of drought. So we're looking there. We're looking at some of the basic materials. There has been a lot of talk, obviously, about increasing the solar space. Another announcement today by Biden that M-Phase was something that was going to get a $60 million infusion of cash. So I think anything that has to do with the EV space, not necessarily the EV space itself, but anything that supports the EV space. So we've been looking at some of the basic industrial metals again that got really beat up. Defense, I think, is always a good idea. And biotech, which has been really doing nothing for the entire year, could actually start to do a little bit better. We're looking there as well. Some of the ones, again, that have been beaten up in the IBB or the XBI space.
All right, Michelle, so, okay, we're broadening out this conversation. So the adage used to be sell in May and go away. That didn't happen. You say sell in July. Should it be sell in July and fly?
Good one, Diane. I'm going to use that.
Go right ahead.
Well, July is a very interesting month because the year is half over, right? So what we had in January, and then we do it again in July, is a 6-month calendar range. And of course, nothing is 100% when you're looking at this sort of statistics. But in January, it worked amazing, right? As soon as we hit January, Nasdaq in particular reached above a 6-month calendar range high, which means that the first 10 trading days in January develops a range. And if you get above that range, you have a good edge in terms of it having follow through. And that happened. Whereas in the small caps, it happened briefly and it hasn't been above that 6-month calendar range high since. We reset now in 10 trading days, which will be about July 18th. Once again, if these small caps continue to fall under pressure and break down under the July lows once we get to that point, and Nasdaq cannot clear that 6-month high again like it did in January, I would say that there's a good chance that, yeah, sell in July as we get into some really strong headwinds after all the optimism we had the first 6 months.
And we know that there's typically lower volume during the summer months as well. But even in that lower volume, are you anticipating that we'll see some slippage over the course of the rest of this summer, or just kind of some choppiness that is perhaps netting out neutral by the end of it, which for a lot of the banks that are still bearish for their outlooks for the S&P 500 by the end of the year, it seems like more of them are expecting that slippage to perhaps take place. And if that does take place and ensue during Q3, what does that even spell out for Q4?
Well, yeah, I mean, I don't think I remember seeing such different calls for what's going to happen in the market over the next 6 months. Some people think that we're going to new highs. And they're using all types of reasons why. Obviously housing market is stronger and the jobs market is stronger. And from a technical standpoint, really basically what happens Thursday and Friday, we have not had 2 down days in a row since May on a Thursday and Friday. So people are looking at all these reasons to be extremely rosy. And then, of course, you have the banks that are looking mainly at this yield curve inversion, which has led to a recession almost every time, even if it doesn't happen exactly in the timing that everybody thought. So, yeah, I would say that we're definitely looking at, if we're looking at it as a trading range, and particularly going back, maybe even use S&P, forget about small caps. If 4,400 to 4,500 turned out to be the top of the trading range, which is completely in line with the small caps going to 1,900 and not getting through, then it makes sense that we could see a move down even closer to 1,700 in the small caps again, which of course would bring the S&P back down at least to 4,000 and maybe back down to 3,800.
Michelle, you say a lot of people are looking for everything to remain rosy. Are you expecting something different for this back half of the year?
Well, again, the first 6 months, there was nothing but reasons to be cheerful. So, right, we had, first of all, the Fed certainly slowed down the rate of change in terms of how much they were going to raise the interest rates. And people were anticipating some kind of pause or pivot. And they themselves have said that they were going to kind of cap it at 5 to 5.25% in terms of the Fed funds rate. So that gave the market optimism. The economic situation was that it seemed like it contracted enough. The consumer was strong and continued to buy, whether it's because of YOLO or whether they thought that inflation had peaked. And that was the other thing, is people thought inflation had peaked. And all these reasons, and especially the AI explosion, gave the market optimism for 6 months. Markets forward thinking. So now you have to wonder, where's going to be the optimism for the next 6 months? I'm not necessarily seeing it because there are so many areas that could be cause for concern, including geopolitical situation, social unrest situation, obviously rising yields, and inflation based on Mother Nature that's not so easy to control. So the consumer is stretched, and we'll see if they can continue to stay in the game. If they can, that's a good reason to be cheerful. If they can't, not so much.
Michelle, stay with us. You mentioned geopolitical, and we want to continue to kind of look at the international situation as of right now. China's economic recovery is stalling. The country's benchmark Shanghai Composite Index, it's on track to shed most of its gains since the year began, as weak data continues to weigh on confidence in the nation's recovery. Look at what's ahead for the world's second largest economy and what a faltering recovery could mean for other markets across the globe. We're joined now by Michelle Schneider, MarketGauge.com chief strategist. So, Michelle, first, let's start there, because there's the recovery that China is in control of, and then there's the recovery as well that will be perhaps a byproduct of more partnership internationally or globalization efforts in the face of deglobalization that's already taken place.
Right. It's so complicated when you talk about China, because obviously there's always the question on whether or not we're getting the statistics in the most accurate and timely fashion. But there's a couple of things that we do know about China. Number one is they have a very long range view, right? They're not necessarily like we are here in the US. They're not necessarily looking at month to month dot plots like the Fed does here, and if this, then that. They have a long-term view that they've already put into place. One, of course, was to basically eradicate poverty, which they have almost successfully done. And in the course of that, they built a lot of housing, some of which hasn't gotten filled yet. And so that's been one of the things that have put pressure on China. Another thing that has put pressure on China, of course, has been that there was a huge amount of restriction in their own technology sector that was put on by President Xi. And that caused a tremendous drop in companies like Alibaba and Baidu. And I think that's been rolled back. And of course, now what's happening here with the US, and of course, Janet Yellen is on her way there, if not there already, has not helped, as other countries are starting to look elsewhere for some manufacturing. And of course, The other thing, China was really, really late in terms of coming fully back, if they're even fully back, from COVID. So you put all these things together, we've got a blip right now. Longer term, though, as you mentioned, Brad, China is trying to make deals. They've been working with Russia. They've been working with India. There has been talk through BRICS about the yuan being more international in terms of a currency to be used. And so I don't necessarily think that right today would be the time to invest in China, but I would certainly not think that from a long-term standpoint, it isn't setting itself up for some very low-risk opportunity.
Michelle, I want to ask you, you mentioned obviously Yellen being in Beijing. How do we view that? Is that good for the U.S.?
Well, it can't be bad, right? It certainly can't be worse than what we've had going on so far. And like Blinken was there, and I don't really know if there was anything great that came out of that particular meeting that they had. And now Yellen is going to be there really more specifically to try to boost cooperation between the two countries. And so I'm hoping that there's some level of success there. Of course, again, right, Diane? So complicated, because if we start to rely more again on China for our exports, in terms of them taking stuff from us and us taking stuff from them, and the trade deficit gets shifted a little bit, that could be actually more of a problem. But let's hope that that she could go there and at least make some inroads.
I want to pivot a little bit, Michelle. Well, you talked a little earlier about weather, extreme weather, really a growing concern as we enter the second half of the year. Now, this week saw the highest average global temperature on record. I know we felt it here. So what do you expect to be, and are we underestimating the economic, financial impact of growing issues with regard to extreme weather and climate change?
I absolutely think that we are underestimating it. And it's unfortunate that there is a political ramification with this whole conversation, which I will try to steer clear of and just say from a factual standpoint. There has been drought, obviously tremendous drought. There's been tremendous swing in the weather, as you mentioned, the record high in terms of heat. I mean, and people have to understand, record high means as far as they have actually measured heat. So it really goes way back. And, you know, could you argue that this is going to be temporary and it will resolve itself in 2, 3, 4 years? Maybe. We don't know. But what we do know is that there is a correlation between emissions from oil and gas and weather. We do know that the sea levels are rising in certain areas, which is why you've had these incredibly tremendous floods and typhoons and hurricanes, and we're heading into hurricane season. So yeah, if you just look at all of this, you have to say we're already seeing an economic impact. Look at the fires in Canada and what kind of impact that's having. And lumber prices, which were falling, started going back up. And that's the kind of thing is you have to look at the ripple or the domino effect of this and say, at what point do companies, certain companies that have the pricing power to be able to withstand that, while other companies won't be able to, they'll have to raise their prices. And of course, that will impact the consumer. It's always back down to the consumer.
Where will this begin to show up, do you believe, most immediate, Michelle? Because we're already thinking about, and I'm actually thinking about some of the work that our social media team did in looking at some data that was from the Insurance Information Institute, I believe, just at premiums of insurance. And over time in a state like Florida, how that's risen, especially given the fact that you've got more severe weather events.
Well, when you say where do I think that will show up, you mean in terms of which commodities might be impacted, or
where for the consumer, whether that's insurance, whether that's, you know, how you are thinking about even making sure that the home that you're building is more resistant to some of these events too.
Well, right. I mean, just having fire and flood insurance. I mean, we live in New Mexico, so fire insurance is something that you absolutely have to have here. And that was not necessarily a big concern in the East Coast or Canada. Now, of course, that is. Flood insurance in Florida has been a must, and that also has increased to some of the other areas. So that's going to be. But, you know, I look at really what happens to food prices and even oil and gas prices. While we're starting to do more mass adoption into EV space, the truth of the matter is most cars are still oil and gas fueled, homes are still oil and gas fueled. So I think that's really where you're going to have to look to see the impact of consumer. And even though gas prices have come down, the oil prices actually, in the face of all of the high interest rates and everything else we've talked about, are starting to creep back up. And if we start to see oil getting past $72 a barrel and then past $75, $76 a barrel, I think that that trickle effect will be huge for consumers, definitely. And that will just add a lot of stress all around.
Michelle, learned something new about you every time we talk. Didn't know you were in New Mexico, the state that houses both Albuquerque and Truth or Consequences, New Mexico as well. Thanks so much. And Michelle, stay with us. We've got much more markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Not enough people are focusing on the fact that things are getting significantly better than where they were with regards to inflation and with regards to policy tightening. Inflation is actually going to be very close to the central bank's comfort level fairly soon. And that's a far cry from where we were a year ago. And that sets the stage for the Fed to end the tightening cycle, which typically creates nice conditions for markets over the subsequent years.
A new earnings season just around the corner. And as usual, big banks like JP Morgan Chase, Wells Fargo, and Citigroup will kick off the busy quarter next week. But Wall Street's biggest banks might be facing tighter profit margins following the aftermath of the banking crisis and collapse of Silicon Valley Bank back in March. Now, some analysts are painting a gloomy picture for this quarter, saying Q2 is expected to be the third consecutive quarter of declining S&P 500 earnings. Michelle Schneider, MarketGauge.com chief strategist, is still here with us. So, Michelle, do you agree with that assessment?
Well, if we look at what had boosted the bank earnings in the past, a lot of it was from their financial side, right? From people being involved in investments and that liquidity that it added to banks, and also being able to borrow money, which right now is much more difficult at these higher interest rates. And even though the housing market has been strong, obviously mortgage applications have been impacted by rising rates. So yeah, at this point, I would think that for this quarter, we will not necessarily see very strong bank earnings. And you mentioned the banking crisis. Some people feel that it was just a little bit too soon in terms of saying crisis over. I mean, what did it last? Like about 4 days. And so the higher the interest rates go, that could put a lot of squeeze, particularly on the commercial real estate and the regional bank side. So I would not have great high expectations at this point.
Do you think there's a theme that emerges this earnings season? It seemed like last earnings season, it was all about how can we say AI in a various amount of ways for companies who had no business saying it, some of them. So, Michelle, is there one theme that you believe will emerge this earnings season?
Well, again, I think that you have the advantage is going to be to any of these companies that have managed to survive throughout the first 6 months because of their operating cash flow, and that has given them some level of growth. And, that's why you have to mention AI, right? Because that certainly has happened there. So that's kind of what I would continue to look at. I mean, just take Nike in terms of the consumer space, right? Earnings not great, and Nike stock has been falling. So if that's any kind of foreshadowing, that means that we will see a lot of stress in terms of the earnings. And it's going to be, of course, what they say about future as we get through the rest of the year. And at this point right now, with expectations of 2 more interest rate hikes, and as we talked about already, inflation not necessarily being controlled, at least in the places that affect consumers the worst. I would think that we'll see AI probably still do well, Apple, all these companies as they continue to compete with one another, but a lot of the other companies not necessarily doing so great.
So can you name more of those companies besides Nike where you expect to see some stress? Would these be consumer-facing companies, or where are you expecting to see the stress?
Well, we started with banks, so I think the banks can set the tone for sure. And if they do not come in great or worse than expected, right? I mean, the thing with earnings seasons, first of all, is that it's always looking backwards. Mm-hmm. And it's really about what the actual number is versus the expectation. That has the greatest impact to the market. And even that is sometimes a short-term impact. So the longer-term impact generally is what they project going forward, the guidance. And so, let's take some of the high flyers in terms of the consumer space that we've seen in the past, Lululemon being one. I think that those kind of companies could actually start to feel the strain, whereas some of the fast food companies that had stress could actually start to come back a little bit, like a McDonald's, for example. So I think that's really, you have to think what's going to be, if everything we've just talked about, Diane, turns out to be true, if the market has seen a top, if the yields are going to have to be stretched, if we are going to enter more stagflation, potentially recession as we get into 2024, where are these companies, where are people going to spend their money? And they're going to spend the money on more of the staples, which did terribly, Target, of course, it had its own reasons for doing bad outside of being staples, which went down against discretionary, but that could rebound. A company like Walmart could continue to do well, where people are going to go and buy cheapest goods they can get at this point.
Michelle, just lastly, while we're on this topic, one of my favorite conversations to kick off the earnings seasons is with Delta's executives because it gives us a sense of where this counter-cyclical recovery that we've heard about from travel companies is continuing, or what type of consumer profile they're continuing to engage with, particularly across services spending right now in the experience economy. Are you expecting for there to be any slowdown within that?
Well, it's such a good question, Brad, because we actually were in the cruise line stocks and have taken some profits along the way. And I've talked to people who do go on a lot of cruises that said they're booked out for at least the next year. And so, again, at this point, that still could be an outperforming area as people seem to be cutting back in certain things, but yet wanting to get out, wanting to get away, wanting to go on a cruise, wanting to get on a plane. Do I think that that can be impacted? Of course. You know, as we know, when things get sour, if they go sour, it's really hard for anything, particularly in this more sort of discretionary area, to sustain. And then we have this other kind of crazy thing going on, which is the possibility of labor unrest as wages continue to have to increase to keep up. And, you know, you had a strike right now in UPS, and I think it's still out there. And there's been threats of airline strikes. So I think I wouldn't necessarily be all that overly optimistic anywhere when it comes to the equity space, even in the airlines and the cruise lines.
Interesting. So maybe some caution ahead. All right. Michelle Schneider, thank you so much. We appreciate you for joining us today. Michelle Schneider, MarketGauge.com Chief Strategist.
Thank you.
All right. You got it. All right. Trading just kicked off on Wall Street several minutes ago now. You have stocks under pressure, not the kind of triple threat bulls would be looking for. We got Dow down triple digits, S&P 500, Nasdaq under pressure. Let's get over to Brad Smith at the Yahoo Finance Interactive.
Yes, we've got it loaded up here on the day.
Right now,
there we go. Let's take a look at the Dow Jones Industrial Average kicking off today's trading session. As of right now, you're seeing that down by about 0.9%. Let's give you a year-to-date view, just to give you some context in today's trade and over the course of 2023. We're still net higher by about 2.5%, but under some pressure today. No doubt some of the Fed meeting minutes from yesterday, we saw that really rattle the markets a little bit, as well as some data coming out this morning on the employment side. Private payrolls, ADP private payrolls in June, that signaled 497,000 jobs added. Wages, these were up by about 6.4% annually. And why do I bring that up? Well, that could potentially signal a Fed that is still looking at the employment situation and saying there's still some juice there. So we've still got room in our policy to make sure that we are combating inflation here. And just as I'm kind of retoggling to make sure that we've got the rest of the averages, yes, we do. The Nasdaq Composite, let's give you kind of a 2-day look at that here as we've got this abbreviated trading week. Over the past 2 days, we've seen some down activity here, and a lot of that really concerted here on today. You're seeing the Nasdaq down by about 1.2%, and the S&P 500, that's down by a percent out of the gate here this morning. Let's take a look at some of the sectors here within that S&P 500 with the brief amount of time that we do have left here for this Wi-Fi interactive check. We're taking a look at staples. I mean, really across the board for all of the 11 S&P 500 sectors. There is red across the screen here. Real estate pulling up the caboose. That's down by about 2.4%, and staples is the best of the worst in terms of the all red that we're seeing right now. And then just taking a brief look at the Nasdaq 100 intraday. You've got some deep red here. Take a look at Google. That's down by about 2%. Tesla down 2% as well. Nvidia 1.6% in declines there. Not too much green to be found, but if there is one area that's green, it is Meta here, as they have just unveiled Threads. And of course, as you're seeing that trade flat, but to the upside here on the day. Diane?
All right. Let's take a look at some other specific stocks. We're keeping an eye on airline shares today. Take a look at shares of JetBlue, American Airlines, both under some pressure. JetBlue down 2%, American down almost a 1.5% after terminating its partnership with American. That would be JetBlue. That's following a federal judge ordering the two carriers to end the agreement over antitrust issues back in May. Now, JetBlue saying in a statement that the airline will focus on completing its $3.8 billion acquisition of Spirit Airlines, which we know that's been met with some pushback from the Biden administration as well, arguing about, just the issues with decreasing the competitive landscape with that tie up there. But JetBlue fought for that deal.
Yeah, well, and for JetBlue, the context here around the Northeast Alliance, this was something that had commenced back in, or at least was announced back in July of 2021. And according to the Justice Department, resulted in those operators really taking up by about 80% of the market share between some of the locations spanning Boston and Washington. So you think about those routes. But again, the Northeastern Alliance between American and JetBlue and those major airports that they service, that was long looked at as an area that was going to be due for some regulatory scrutiny. But at a time where there is more capacity coming online for all of the airlines that are trying to get back to or still get back to pre-pandemic capacity, or in the case of JetBlue and, of course, the battle over one of the my least favorite airlines, Spirit. I've not been bashful about that.
It's the same. I'm on the same page.
But on metrics here, it's an airline that has very low net promoter score. All right, so it's not just me saying that; it's the facts.
Yes, I mean, they fought for this one. But what has been, while this, the dissolving of the partnership between JetBlue and American hasn't been good for the shares of either of those companies, Spirit getting a boost today. Spirit flying a little bit higher. Sorry, had to. But,
good for them. All right.
All right, we're also keeping an eye on shares of Teva this morning. That stock kind of fluctuating a little bit this morning, dipping just 0.2%. This after the pharma company considering options for a possible sale of its active ingredients business, according to Bloomberg. The deal could value its business at about $2 billion. Yahoo Finance's Anjali Kamlani has the details. Hi, Anj.
Hey, Diane. That's right. Teva, an interesting story this morning with the report of the potential sale of the unit. What that covers really is about 400 APIs or active ingredients for the company. And that is an interesting part of the business, which is profitable. The company is already facing so much debt. So this could be a way to kind of leverage all of that. They're facing about $20 billion in debt, including, let's not forget, that $4 billion in the opioid settlements around the country. Now, what's going on with Teva, though, is a little bit of an interesting story because for a long time it's been known as this generic company. So if it does sell that unit and starts to focus more on innovation, it would kind of switch what the company profile looks like a little bit. But it's following suit of what we're seeing really in the pharma industry. The industry right now facing pressures from a number of directions, including inflation, of course, but also the Inflation Reduction Act and things that came from there, including Medicare drug pricing, as well as penalties for increasing prices. That means that, these companies are really looking for more M&A activity to kind of boost their pipeline. They're also facing patent cliffs for some of their blockbusters. Teva's already gone through that. And so this move could be one of those that kind of helps it fall in line and follow suit in what's going on broadly in the industry. The industry has kind of bucked the trend of slowing deals in the past couple of years. 2021, a record year, of course, fueled a little bit by the pandemic and interest in the healthcare sector. But there has been a little bit of slowdown last year, but there's been forecasts that the industry is not going to necessarily fall in line with the rest of the economy and slow down as much. And just a quick note, Teva upgraded from sell to neutral by UBS this morning on the news of this potential sale. So probably an upside there for the company.
All right, Yahoo Finance's own Anjali Kamlani. Thanks for breaking that story down for us this morning. Appreciate it, Anj. And let's take a look at shares of ExxonMobil as well this morning. The stock trading lower today after the biggest U.S. oil producer warned that Q2 profits would fall sharply from last year over weak oil refining margins and lower natural gas prices. The company is set to report those earnings on July 28th. They did this through an SEC filing, giving an update on some of the figures here. And without making people's eyes gloss over here, I think net in just what we had mentioned a moment ago, a few of the things that they should kind of remember here is that this was a company that had talked about where they're kind of growing value and increasing production from assets to try and meet global demand, while at the same time trying to make sure that they've got a low carbon solutions team that grows out their new business with additional carbon capture as well. So really kind of a balancing of the dials here for ExxonMobil, but at least in the near term, this is going to be one of the larger impacts here for the company, given some of the refining expectations that they had set forth at last quarter.
And you wonder what this does in terms of setting the stage for big oil in general, if you'll see other oil majors kind of come out and cut their guidance as well. It will certainly be a space to watch, and we're seeing a bunch of the oil producers under pressure as a result. Obviously, Exxon getting knocked the most, but then you see Chevron getting dinged as well, ConocoPhillips as well. Even Occidental under some pressure off the back of this reduction of their guidance right now.
And it seemed like some of the projections, at least the expectations, consensus from Refinitiv at least, were looking for a per share profit, EPS, of $2.27 for the quarter that they had just given this disclosure for. So that seems like it's going to come in below the expectation that at least the street was looking for as well here. So we'll continue to see exactly. And we're going to be watching exactly when they report earnings. That is still set to come. But all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
Are we going to see a recession this year?
Good question. Comes up a lot. I'm going to say for 2023, not likely. 2024, more likely.
I'm going to say that we will know if there was a recession this year after the NBER declares that there was a recession that we entered into this year, which will likely come well after the fact.
Fair enough.
Fed's hawkish tone is sending stocks lower this morning. So what does this mean for investors? Yahoo Finance's Jared Blickery joins us from the floor of the New York Stock Exchange. Hey, Jared.
Hey there, Brad. Looking a little bit negative on the Wi-Fi Interactive here. We're seeing all sectors, all 11 sectors in the red. Best performing are the defensive ones, healthcare, that's XLV and XLP, which is staples. Looks like real estate, which was the best performer yesterday, taking a back seat today. I'm going to move on to the bond market in a second. First, I want to cover some patterns and people are noticing on Twitter, not Threads just yet, but on the Nasdaq Composite, potentially seeing a double top here. This would be on a short-term basis. By the way, double top not confirmed until you breach the neckline, so stocks could or the index could very well do something like that. Any number of possible permutations, but just want to point out what people are noticing. Also seeing the same thing in the S&P 500. But I want to talk about positioning and also sentiment. So if we take a look at what's happening in the VIX right now, we have been seeing a lot of complacency. These lows right here that we saw during June, those were some of the lowest level we've seen in years. And now volatility picking back up a little bit as stocks turn over just a little bit. Protection is still cheap, and protection is best bought when it is cheap, not when you need it. When you need it, it's usually much more expensive. You're looking at something north of 20 in here. Also taking a look at the VIX of the VIX as a leading indicator, that has ticked up here. And then finally, the bond market volatility indicator, ICE of a move index. We're still seeing that fairly depressed here. However, I did say there was something interesting going on in the bond market. 10-year T-note yield exploded to the upside yesterday. This is the highest level, I should say, in months, back above the 4% level in the 10-year. And I think we're going to find out, does higher for longer really mean the bullishness that everybody's been taking the market to believe? I think when you take into consideration all the complacency and the gains that we've seen so far, market participants should be on alert here. I want to close with this. This has to do with sentiment, and this is the CNN's Fear and Greed Index, along with S&P 500 rolling 12-month returns. The cyan line is the greed index, and you can see it's the highest that we've seen, goes all the way back to about mid-year 2021, and then we have the S&P 500. So when this peaks, when the Fear and Greed Index peaks, we do tend to see a peak in the S&P 500. How long it lasts, we don't know, but things are pointing towards a bit of a pullback here, guys.
All right, not just pointing, we are already in a pullback, it seems. Professor Jared, thank you so much, as usual. All right, Tesla and top China automakers are pumping the brakes on the ongoing price war that shook the space this year. Companies like BYD and XPeng joined the Elon Musk-run company in signing a pledge to regulate EV pricing in the country after calls for a crackdown. So does this signal an official end to China's pricing wars? Michelle Krebs, Cox Automotive Executive Analyst, joins us now. So does it from your view, Michelle?
I think the jury's still out on that. It's not clear how binding this is, and it's a very competitive market. The Chinese market is the biggest EV market in the world, and everybody wants their piece of it.
Right, and so now that we kind of think about how these competitors are going to go after a consumer and trying to make sure that their EV is perhaps the most adaptable too in the changeover for some of those drivers out there from a combustion engine to an EV. How has the infrastructure messaging moved forward in a region like China versus what we've seen in other parts of the world?
Well, the Chinese government has really made shift the transition to EVs much more. They're pushing it a lot more than we have been. Mm-hmm. The U.S. is just getting on board with that. We've been a little behind. Europe is pushing it as well, but China by far is the lead. So there is a big push on every aspect of moving to EVs.
Michelle, let's talk about EV expectations for domestically. What's your expectation for this year?
We believe that this will be the first year that electric vehicles hit 1 million units. We were at about 800,000 a year ago, and we think we'll surpass that 1 million mark, and we're on track to do so.
And then additionally, when you think about beyond new vehicles, some of the existing vehicles that perhaps will make their way into the circular part of the economy, which is really just resale or used vehicles at that point. Are we seeing any pickup among used EVs right now?
We're starting to see some of that build. We haven't been selling EVs all that long, and what was out there was mostly Teslas. But we are starting to see some inventory build for used vehicles, and that should be a good market for people who want an affordable way to get into the EV market, because new EVs are pretty expensive at the moment.
Speaking of affordability has been an issue when you're talking about new vehicle sales. The prices continue to just remain elevated. What's your expectation, your forecast for this year for new vehicle sales in total?
We're a little bit more cautious than others. We had a very robust first half, surprised us, and so we upped our forecast. We expect 15 million vehicle sales this year. That's about 1 million more than last year. But the market was running hotter than that in the first half. We just think that we need to be a little bit cautious about the second half. We know that there's going to be another interest rate increase, and possibly two. And there's already been a lot of pent-up demand unleashed. And we just wonder how much more of that is there. We've seen that on the retail level, and we've seen that on the fleet level. So we're just being a little bit more cautious about how the second half will go. We're also facing a possible strike by the UAW as they negotiate a new contract with Ford, GM, and Stellantis.
For GM, since you just mentioned them, we got their second quarter figures, and 691,978 total vehicles sold, and 15,000 of those EVs right now, about 15.6 thousand of those being EVs. At what point in this broader kind of EV war do you foresee there being a real competition from some of the legacy U.S. automakers like a Ford, like a GM, and competing with the output, the production and the deliveries that Tesla is seeing, even though not all of those necessarily are based on new purchases, given that they're getting through a backlog in some cases?
Well, we think the pie is going to grow bigger, and that these legacy players, as well as some of the newcomers, will take a bigger share of that. We already have seen that Tesla's market share will come down. They're still dominating in the market. They're still number one in EV sales in the U.S. and luxury sales, for that matter. So they will still dominate, but they will have more competition from. We'll see others taking pieces of that pie.
All right, Michelle Krebs, we put a pin in our conversation there. We appreciate both your forecast for the year and insight on the EV space. Cox Automotive Executive Analyst. Michelle, thank you.
Thank you.
All right. We've got some great interviews on tap in the next hour. Who is benefiting the most from what one analyst is calling the magic elixir of AI? We'll discuss.
Plus, we'll get a pulse check on the economy with some breaking data on job openings. That is straight ahead. All your markets action coming right up. Stay tuned. You're watching Yahoo Finance.
The FANG trade is not retired when the U.S. economy is still searching for some type of catalyst to see better growth. And in a slow growth world, and quite frankly, we may persist in a slow growth world for some time, investors are going to look for higher quality businesses that can grow in a fairly modest growth environment. And so it doesn't necessarily need to be all of the FANGs, but many of those companies are going to be the long-term persistent growers.
It's just after 10 a.m. in New York City. This is Yahoo Finance Live. I'm Diane King Hall alongside the one and only Brad Smith. We are just about 30 minutes into the trading day, and we're watching shares of Affirm sink today after Piper Sandler cut its rating for the stock to underweight after being neutral for more than 2 years. The analyst saying that the buy now, pay later firm will start to feel the pressure of higher rates, and student debt repayments will cause a slowdown in spending. Those high interest rates may be getting even higher. The analyst saying the company will see lower growth on sale revenue and higher funding costs for loans held on their balance sheet due to the Fed's tightening.
And Sweet Green, on the other hand, is rising this morning. Bank of America upgraded the stock to buy from neutral and boosted the price target from $9 to $17, seeing a 30% upside potential for the stock. The analyst laid out the 3 reasons why. 1, increased foot traffic. 2, prospect of momentum in same-store sales growth. And 3, long-term plans to automate operations.
Meantime, we are also watching Coty. The company raised its fourth quarter and fiscal year 2023 guidance at the group's first investor conference in Paris this morning. The dual-pronged consumer and luxury company saying it is seeing robust demand, expecting 12 to 15% revenue growth in its fourth quarter. CEO also answering questions about its deal with Gucci, saying that there will be no discussion of a renewal of its Gucci license deal for at least 5 years.
All right, we do have some breaking economic data that's come out this morning, and this is the job openings labor turnover survey news that's just dropped, aka known in your hood as JOLTS, and the number of job openings decreased to 9.8 million. That was on the last business day of May. So this is data for May 2023. The BLS reporting this data, and of course the number of hires and total separations also come along with this report. That was little changed at 6.2 million and 5.9 million. Separations and quits, that came in at 4 million. That was increased, while layoffs and discharges, that changed very little. That came in at 1.6 million as well. Just in terms of some of the other context that they added on here as well, the number of job openings in that decrease, that moving lower by about 496,000, that followed that increase in April and declined by about 0.3 of a percentage point to 5.9% for the job openings rate there.
Right. And so looking at in terms of sectors where you're seeing drops, the biggest decrease was in healthcare and social assistance, followed by finance and insurance. Other services also saw a decline, and we know we've talked to different economists and analysts about, possible concerns about the strength of just services sector in general holding up. And then but on the flip side, you had increases in educational services. Remember, we talked to someone yesterday who talked about just the need for the economists we talked to yesterday.
Teachers, yeah.
For teachers. So there's still growth there. I was actually surprised to hear that, but so there's still strength. I mean, you're also seeing some turnover there in terms of education. So interesting to, kind of take that into context with all of the employment data that we're getting today. And of course, the granddaddy of them all coming tomorrow.
Yeah, and of course, Yelena Shaletyeva was teeing up that jobs report in the monthly, which is going to be at least a little bit closer to the pulse of where we are right now versus the lag that is in the JOLTS survey. But key for her to mention the educational services and the job openings increase. That was for May. It'll be interesting to see what June holds for the employment situation, the monthly report to come out. Also, we saw government jobs increase by about 24,000 there. But it's going to be interesting to see exactly where in finance, for insurance, for some of these larger kind of professional business services, where that sees some moderation in tomorrow's report too.
Yeah, indeed. And also seeing if tomorrow's report matches up with what we saw today from ADP.
There you go. Well, we've got some strong employment data today ahead of tomorrow's jobs report. You mentioned ADP. Let's dive more into that. ADP's national employment report saw private sector employment jump by 497,000 jobs in June. That's way above the 220,000 estimate, with most of the jobs added in services like leisure and hospitality. The report also saw annual pay increasing 6.4% year over year. Meanwhile, there were 248,000 jobless claims during the week ending July 1st, close to a 2-year high. with most of the increases popping up in just a few states, including Michigan and New York, which could be due to annual summer retooling at auto plants. The rise in claims don't point to a major pullback in the labor market. In fact, the 4-week moving average of claims dropped by 3,500, and that came in at 253,250. Our next guest says that we could be at the risk of the Fed fund rate climbing to 7%. Climbing to 7% to 8% perhaps if the labor market doesn't slow down. Joining us now, we've got Chris Rupke, who is the Forward Bonds chief economist. Chris, help us break that down even more, because that is well above what many have looked at as the terminal rate for the Fed.
Well, if you go back in history, back to 1989, and the Fed funds rate was 10% to slow the economy. Before the stock market bubble in 2000, the Fed funds rate was 6.5%. So right now, inflation is worse than it was in 2000, and it's worse than it was in 1989. So I just feel I've seen this story before. It was a long, long time ago. It was in the 80s. The Federal Reserve back in the 80s found it difficult to get the Fed funds rate high enough to slow activity, because it's kind of hard to judge what the public thinks is restrictive policy, and you get some confusion about nominal rates versus real rates. So if inflation's running about 5%, maybe the Fed funds rate, interest rate, should be a good 200 basis points above that, which would put it at 7%. I hope that's not the case, because I own a lot of Treasury bonds at lower yields, and it's going to incur some losses. But everything tells me that that pause they just did at the June meeting is going to turn out to be a mistake.
Chris, I want to quickly ask you about just your reaction to today's jobs data. The job market has just continued to hold up. I know the ADP report is private sector, but you also had jobless claims continuing just to show some strength there. What do you make of that data?
Yeah, I was a little bit shocked. I guess ADP every once in a while needs to swing for the fences and get our attention back to their index. I guess they're not selling it, but that was quite a dramatic number, 497. You add in 50,000 government jobs that we saw in the payroll jobs number a month ago. Maybe we get another blockbuster 550,000 increase tomorrow. We've seen this before, where some of the data the day before the so-called most important economic number in the world, the payroll jobs report, sometimes the data the day before steals the thunder of the actual jobs report tomorrow. So I was shocked, but it kind of tells you that the labor market's still strong. There's been no real increase in layoffs, despite some of those high-profile layoffs at tech companies. We see home prices are at a new record level. Looking at the data from Washington, new home sales have picked up. You know, how could that be with a mortgage rate of 6.7%, where, you know, a couple years ago the mortgage rate was 3%? It's just telling me that interest rates aren't slow enough to bring the economy to a stop, which is pretty much what needs to happen to try and get inflation under control. So durable goods orders, they're at record highs. None of this data looks like it should if the economy was slowing. About the only thing that's slowing right now is consumer spending. We had a big jump in January, and since that point in time, we haven't really seen that much more consumer spending. But, you know, everything else looks like the economy is pretty good. And
Chris, do we have you? Okay.
To discount 25 basis point rate hike in the next two meetings. Yep.
Chris, it sounds like we still have you. If we can squeeze one more question in with you while connections are stable, we'd love to know how you would classify the consumer right now. We've heard some companies talk about the consumer as resilient, or their spending is resilient, and their balance sheet, the home, is healthy. How would you define the consumer in this environment?
Well, one thing, I don't think they're overburdened by consumer credit. I don't think they've taken on that much consumer credit. I see that headline saying they're burdened, but it's not that high yet to be burdened. The other thing, it's not just consumer confidence, which was better earlier the other week. It's not just confidence. It's not just the willingness of consumers to go to the shops and malls. It's also how many consumers there are with paychecks. So an important reason why consumer spending falls in real terms in recessions is rising unemployment. There's job losses. People don't spend because they can't. They've lost their jobs. So at this point, we really haven't seen a lot of people lose their jobs yet. So consumer spending, it's a little bit slower, but it's not going negative right now. So we're not near a recession yet, despite the yield curve forecasting a recession basically starting this month, July.
All right, Chris Rupke, we will have to leave it there for today. We appreciate you for joining us. Chris Rupke, Forward Bonds Chief Economist. Thank you so much. All right, more of your market action ahead. Stay tuned. You are watching Yahoo Finance.
I have tried pickleball. I play quite a bit of pickleball. I'm historically a tennis player, and I went kicking and screaming, but I actually like it far more than I expected, and we'll be playing a lot of pickleball this summer.
A record number of CEOs left their posts at U.S. companies in May. 224 leaders stepped down during the month, up 49% from the year prior, according to a report from Challenger, Gray and Christmas. Now, as companies prepare to enter an uncertain second half of the year, plagued by potential recession concerns and still climbing interest rates, what does the uptick in leadership shakeups mean for corporate America? William Cohen, Puck News founding partner, joins us now. So is there a crisis of confidence at hand?
Well, look, the report does not say why these leaders left, with any specifics. I mean, some left because they retired, some left because they weren't getting the job done, some had personal issues. So it's hard to know why there would be this dramatic uptick. But look, the economy has changed dramatically since the Fed started raising interest rates in 2022. Cost of money is much higher. The stock market is choppier. Interest rates are higher. Companies probably aren't performing as well as hoped. And so, when the team's not playing well, they don't fire all the players, they fire the manager.
What about for companies that are looking across their leadership? And I think of even what's been announced in terms of transition plans. I think one of them that's come forward was within Brian Moynihan over at Bank of America, and now thinking through what's to come there, as well as some of the other major financial institutions this year.
Well, I mean, succession is, of course, the most important thing that a CEO has to do, is find his or her successor. On Wall Street, there have been leaders who've been around for a long time. Both Jamie Dimon and Brian Moynihan have been around, running their companies now for nearly 20 years.
Yeah.
Absolutely time for succession at both of those places, and but nothing really concrete at either place. At least James Gorman at Morgan Stanley has said that he will be stepping down in the next year, and that there's a three-way competition going on to succeed him there.
Yeah, and thank you for correcting me on that, even as I'm kind of looking through my multiple tabs of notes over here. It is James Gorman of Morgan Stanley. That's the transition that's being placed. Anybody with 75 tabs open has certainly made a mistake similar to that. But, even as we think about now, where for the prioritization for CEOs and for companies as a whole to make sure that their priorities are well laid out to investors, to their internal stakeholders as well, how has the role of the CEO changed so much, even over the past 18 months, to position companies for what that next leg of growth, even after a potential recession, might look like?
It's the biggest challenge that a leader of a company faces. How do you grapple with a slowing economy? On Wall Street, how do you grapple with, a year and a half now of slowing investment banking revenues? Really just have not completely disappeared, but way down from levels that they enjoyed in 2021. How do you grapple with that? How do you grapple with that in terms of paying your current employees? How do you grapple with that in terms of continuing to retain employees or letting them go? In the streaming business and media, how do you grapple with the decline of linear TV at the same time that profitability from streaming is not there? I mean, these are major issues. These are why CEOs get paid the big bucks, as they say. These are things that they have to grapple with, and if they don't, they're going to be the ones who are in the report that you just referenced at the top of our discussion here.
Let's talk specific leaders. You had a piece in the Times about Rupert Murdoch. No one can stop Rupert Murdoch, to quote the headline, and talked about that increasingly being a problem. Can you pull out more of why that is an issue with a tightly held company?
Well, it doesn't have to be. Let's be clear about that. There are plenty of companies with dual stock structures that seem to be running just fine. I think the problem with Fox in particular, as opposed to News Corp, which he, of course, also owns and controls, Fox, is that, we've seen a lot of strange behavior out of that company, much of which was revealed as a result of the Dominion lawsuit that they ended up settling for $787 million, not anybody's favorite moment at Fox. And I think you begin to see revealed a lot of behavior that is frankly unacceptable in a public company, in any company, frankly. And with the dual class stock structure at Fox, who can do anything about it? Rupert Murdoch controls the votes, he controls the management, he controls the board. So when things start going off the rails, as they appear to be at Fox, what can anybody do? What can a shareholder do? What can a board member do? What can another a member of? What can even his own son, who's the CEO, do? And the answer is pretty much nothing. Rupert Murdoch does what Rupert Murdoch wants to do. And again, there are plenty of companies that do have dual class stock structures as well. I'm not saying that, boards are effective there either, but, you're relying, I guess, in that situation on the kindness of strangers to do the right thing. In Rupert Murdoch's Fox Corporation, I think that, he's lost the plot and is not doing the right thing. And there's nothing much anybody can do about it under this structure.
So one more question I want to ask you about Fox in particular. So they just paid out another settlement, much smaller by comparison to that former producer.
Yes.
That was a $12 million settlement.
Yes.
But one more shoe potentially to drop is the issue with Smartmatic, which could be similar to the Dominion settlement, possibly. What are you expecting to come out of that? And does that contribute to the issues that Fox has potentially, especially when you talk about its share price?
Absolutely. These lawsuits should have been settled quietly and long time ago. I mean, the fact that they're allowed, they did not settle the Dominion case. They let it go nearly to trial, settled it the opening day of the trial after discovery had taken place. That speaks to me to be a severe lack of leadership. They at the top. They appear to be doing the same thing with Smartmatic now. Again, I don't know why they would do that. They know by their own analysis of their own email traffic, what they've been doing there. Why they would let this go into the public realm any further than it already is a huge mistake. They should be settling these things, and it looks like the Smartmatic settlement will be even more expensive for Fox than the Dominion. So that's two strikes plus this settlement with their producer. I mean, this is a company, it seems to me, that is completely out of control, and there's nobody that can do anything about it to change Rupert Murdoch's behavior.
William Cohen, Puck News founding partner. William, always a pleasure to get some of your insights, especially around the leadership and the industry that it's covering over top of right now. Thanks so much, William.
Thank you.
We got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. When will the AI bubble burst?
So we're not going to continue to see this type of price appreciation like we've seen this year. But in terms of a bubble bursting, I think AI as a technology is something that's going to become pervasive in many, many parts of our lives and different parts of the market. So right now, it's obviously something that's very focused on a few stocks. I think it's going to get a lot more broadened out. So I wouldn't call it a bubble bursting. I would just call it something that's more pervasive across different sectors of the economy.
Some upbeat news from Microsoft this morning after Morgan Stanley bumped its price target on the tech giant, naming it one of the top picks for generative AI. Yahoo Finance's 3 to 5 anchor Shauna Smith joins us now with the details.
Hi, Diane and Brad. All right, so some good news here for Microsoft. A top pick, like you just said, at Morgan Stanley. The team there, led by Keith Weiss, laying out a few reasons as to why they're seeing such a massive opportunity when it comes to Microsoft and its potential with AI. Now, we know that Microsoft has really been in the conversation as one of the leaders, many times the leaders, when it comes to capitalizing on that AI frenzy that we have seen since the start of the year. So when it comes to AI and what that's going to do here for businesses as generative AI continues to really expand the workflow process that will be automated, Morgan Stanley making the case here that Microsoft is best positioned in this. And they lay out this chart right here just in terms of the products that are incorporating generative AI and really showing Microsoft's advantage in this. They asked a group of people in their survey about how they plan to use or whether or not they plan to use some of these Microsoft products that do incorporate generative AI over the next 12 months. And you can see almost a third saying that they plan to use Azure OpenAI services, about a fifth here, 22%, saying that they plan to use the Microsoft 365 Copilot here. So that really laying out the bull case for Microsoft's growth and their position right now when it comes to the AI frenzy. So when you take into account some of the performance that we have seen in Microsoft stock since the start of the year, it's already up 41%. You can see it starting the year right around $245 a share, a massive run up to where it is today, right around $339. Well, the new price target out from Morgan Stanley is $415. Let's put that all in perspective for you right now. Morgan Stanley is saying that Microsoft, they still see room to run of over 20%. So what's it going to take to get there? Obviously, wider adoption of generative AI. We know Microsoft had a massive $10 billion investment in OpenAI. That, of course, giving them the edge. Morgan Stanley also bringing up the PEG ratio. So that's price to earnings divided by expected earnings growth. Right here, they're talking about valuation. Despite that massive run up that we've seen since the start of the year, they're saying that historical standards when it comes to that PEG ratio, it's actually in line with what we have seen in the past. So some of that fear that maybe Microsoft is overvalued, they're saying that some of that fear is a little overdone at this point. So again, the massive run up, 41% since the start of the year. Microsoft clearly one of the outperformers in the broader market, really riding the tech wave, the excitement around AI since the start of the year. Morgan Stanley, though, guys, making the case that this stock has a lot more room to run.
Right.
Clearly.
Top-notch reporting there from our own Shauna Smith, and as well as the penmanship on the Wi-Fi.
I was trying my best.
That is not easy.
415, I think it came across.
Well done, well done. Thanks so much, Shauna. Also, everyone, since we're talking about AI is the new buzzword, with demand skyrocketing and industries grappling with the changing tech landscape. But our next guest says that while AI might offer a magic elixir, it may not necessarily be a hockey stick inflection for one sector. That's telecom. Frank Lothan, who is the Raymond James telecommunications analyst, joins us now. Frank, great to have you here with us this morning. All right, so what is the magical elixir, perhaps, here, that as you look at it from your perspective?
Yeah, we look at this from our as a team perspective. We've taken a deep dive into AI, and from my side, where I sit covering telecom and data services providers, this is absolutely a positive for them. There's a tailwind, but it's just more of the thing that kind of keeps the growth going. It's not necessarily a hockey stick inflection like we've seen with some of the other sectors like chips and so forth that are more directly involved. But there's absolutely going to be more demand from AI going to data centers, going to fiber providers and network providers and wireless carriers. That is going to keep the growth going over the next few years. It's just a lot more muted than people might think, and it's early days in how it's impacting the sectors.
Frank, I don't know if you just got a chance to hear our anchor Shauna Smith talking about Morgan Stanley's price target on Microsoft and seeing where Microsoft lands in terms of the AI space. Who in the telecom space would you say are the leaders and have the best chance at taking advantage of this huge focus on AI and particularly generative AI?
Yeah, absolutely. So the data centers that we cover, Equinix and Digital Realty Trust, are the ones that are the most directly affected in the short term. That's where companies like Microsoft and cloud providers are going to be deploying their AI engines. You're going to be deploying various things for the AI instances, and you're going to be deploying them for the training modules and so forth. And that's where you're going to see that. And it's also, we're already starting to see it on the margin with some pricing and so forth at some data centers where some of the AI deployments are paying very high prices to get access to data. And the real important thing there is when you look at AI, it's generally run by GPUs versus CPUs. And GPUs use more power. When you look at the data center industry, they sell power. They don't sell space. So as you have a demand driver that's going to use a lot more energy and so forth, that's a very good driver for demand. So we would look at Equinix and Digital Realty as the two most directly impacted by the sector, with the telecommunications networks being after that.
And so some of the names specifically within this, break down some more of those, because you mentioned Equinix, but there are a few others, Akamai, with even within that coverage that you're looking across with this.
Yeah, absolutely. Akamai is another one. The content delivery networks are going to benefit because you have to remember, someone's got to get the data in and out of the data center and in and out of the AI engine and so forth for all the applications. So you're going to need those delivery networks. But then Akamai and others have also developed software security platforms, which are going to be important as well. When you're moving all that data and you're putting it into these various AI platforms, there's going to be increased attacks on software security. You're going to need increased security for the data that you're collecting. Plus, it's going to need to be data that's going to need to be collected and deployed on a much broader basis. You can even make a case that you're going to need to use AI out further in the edge of networks to better filter the type of information that's being sent back, so you don't send everything back, because it ends up being very costly. So we think the content delivery networks also benefit. And then, of course, those that provide fiber and so forth. And eventually, you'll see something on the wireless side. Americans value entertainment and convenience above almost all else. And at some point, if you're going to have a successful commercial AI device, it's going to need to work on a cell phone. So at some point, that will drive more traffic there as well. But all of these things take more time, and which is why we think the more direct beneficiaries in the near term, at least, are the data centers and then probably the CDN.
So I want to really quickly draw this out to something you also say in your note. You said the AI debate really should be about degree rather than direction. And of course, we know that the spending is happening, the investment is happening. But is it big enough to turn this into a question and broad enough to offset any kind of headwinds coming?
I definitely think it is. It's just slow, right? All these things are sort of gradual changes. We like to say about telecom that the rate of change is very slow, even when it speeds up. I've been covering this industry for a long time, and there's still copper phone lines out there, right? So it takes a long time for the industry to transition. But when you see a data transition like this, or a technology transition, like we saw cloud computing a few years ago and so forth, it is a positive. It does tend to, over time, replace older technology and continue to keep the growth going. So that's why we're confident in the growth rates we have for our companies going forward, because this is coming on the backside and going to continue to push revenue and replace where older technology falls off.
Frank, would much rather ask a question about that sick Les Paul you got in the background there, but I do want to include within our conversation here, at least for the day, what is the timeline that investors should be keeping in mind when they're talking about this type of transformation and how AI could potentially impact the telecommunications sector?
Yeah, so when you look over the next 2 or 3 years, I think you'll see it be more pervasive, right? So, for example, the data centers that I referenced, Equinix and DLR, have both said that AI is a part of their conversations, but it's still a very small part of their booking, so it's not quite here in a real meaningful way. And I would say the same thing for the telecom providers and so forth. It's something that when we talk to them, they've all had conversations with their customers. It's things that they're aware of. They're trying to be positioned for when that demand is there. But it's still, on a relative basis, a very small amount of computing platforms and deployments and network traffic. So I would say you fast forward about 3 years, we'll see it be much more pervasive, but it's definitely something that's creating a lot of conversation. And again, if you look at, okay, what's going to continue the growth case over the next year as other technologies sort of fall off, I think you can say AI is the thing that's going to come up and fill the demand void going forward.
Well, that was certainly the case in the last round of earnings. We'll see if that's the buzzword this round. Frank Louthan, Raymond James, telecommunications analyst, thank you so much for joining us this morning.
Thanks for having me.
All your market action ahead. Stay tuned. You're watching Yahoo Finance.
It's going to be a moderation in earnings as the economy slows down, but I think what investors are going to find is that it's not the significant contraction in earnings that many feared.
From potentially throwing hands to Twitter fingers versus Thread fingers, the quickly ended fight between Elon Musk and Mark Zuckerberg gaining steam again online. The two CEOs now locked head-to-head in battle for consumers' attention after Meta launched its Twitter killer app, Threads, on Wednesday evening. The latest Meta family member already boasts over 10 million users and more set to join. Let's bring in Mark Schmullick, Bernstein Internet Research Analyst, to talk about what Threads can do for Meta. So is it a Twitter killer, Mark?
Look, we're in the first pitch of the first inning, so far too early to tell whether it will or won't, take on and challenge other apps in the space. But, ChatGPT got a lot of buzz for getting to 1 million users in 5 days. Threads did it in a few hours.
So will advertisers flock to Threads?
If and it's a big if, that we see this application kind of take on engagement. So it's one thing to get, initial adoption, people downloading it, they'll try it out. What you really need is that re-engagement. Otherwise, the app collects kind of, the effective dust on the digital shelf. But if you get the re-engagement and it becomes a sticky app with real utility, then the advertisers, I fully believe, will follow. This is not a near-term thing, but one of the ways or the primary way that you sign up for Threads is you use your Instagram account. And so your profile ports over. And so all of the targeting capabilities that Meta has to bring to bear to show you ads on Instagram, it could take a lot of that same data and behavior and effectively apply it to a brand new screen with brand new ad inventory.
Mark, did you join it last night, and what'd you think?
I did. Proudly, I was very early on. You could track your number on Instagram of when you joined. And look, it's certainly a fun app to use. A lot of similarities with Twitter, certainly. You could see the recommendation algorithm at work of effectively sourcing content from outside of my network as well. But look, there's still a lot of features that I would love to see that haven't yet come. Searching for content, a follower page specifically, direct messaging, etc. As Zuck says, it's version 1. We're just getting started.
All right, so, we've seen so many iterations of features or apps or services that Meta platforms has either acquired or brought about or built out themselves that really just kind of mimic other ones out there, whether you look towards Snapchat, whether you look towards some of the features that they've copied with TikTok and made that into Reels. This just another instance now for people to look at Twitter versus Threads to decide, okay, which experience do they like better when both of them really do the same thing. So at the end of the day, does Facebook need to come up with anything brand new as long as they're able to just mimic something else well enough?
I think one of Meta's real strengths is this ability to execute. It's not about coming up with new ideas from scratch per se. It's about figuring out what formats work and doing it better and scaling it faster than anybody else. That's their strength, as you've mentioned. Their ability to effectively build out a short form video product inside of their existing applications with Reels. To their view, if you think about the game of kind of what they do and what they sell, which is they're trying to entertain you and give you an opportunity to connect in as many different ways as possible, and they monetize it via advertising, which is really just a function of how well they can target you, but also how much time you spent within their kind of ecosystem. And so if they see an opportunity to kind of expand their product suite or their application suite into something that's very text-based, which is a little bit different than how their other applications effectively work, solves an incremental use case and effectively draws more time into their ecosystem, then they're best able to monetize it. And that's really been one of their key strengths as a business pretty much since the beginning.
So is Meta, remember they were supposed to fight. So is Meta now the heavyweight that won this round, or too soon to tell?
Look, far too soon to tell, but certainly we see a very different kind of Meta before us today, where, it wasn't too long ago where we were wondering whether TikTok was going to eat their business, whether Apple had permanently impaired their ability to monetize via advertising. And here we see a Meta on the front foot, going after newer opportunities rather than simply defending the fort. So it's a really exciting time to watch what's happening.
Does this lead you to upgrade Meta in any form? How do you rethink what the valuation should look like on this company? Is there any type of multiplier that Threads gives a Meta versus some of the other social companies that are publicly traded?
Not yet. That's the short answer, is not yet. The longer answer is, my general mantra as I think about internet and consumer internet particularly is it's incredibly difficult to change consumer behavior, to create something new. Sometimes you catch lightning in a bottle, sometimes you execute and it works, but it's putting the cart before the horse to effectively assume that this is going to take off and see, real returning user engagement in a whole new way of how we use an entirely different app. Remember, for all the successes that we've talked about with what they've done with stories and what they've done with Reels, I can recall not too long ago when they were very excited to launch, Facebook Shops. And we really haven't seen that materialize and develop the way, we might have thought about kind of Facebook and Instagram as a commerce destination. So it's exciting, and it's certainly like a, kind of like a green shoot opportunity. But far too early to kind of place any specific valuation on really what's just an idea with a lot of momentum at the moment.
Does Threads need to be shoppable?
No, it doesn't. If it's shoppable's nice. What you really need is you need to be able to kind of do something that, I think has long been the criticism on what you would call the closest, kind of competitor in that space is Twitter, which is, can I make the advertisements relevant to you and closer to that shopping behavior, be it downloading an application or buying a product or service. The problem with Twitter's advertising business has always been it was slightly more up funnel, so it focuses more on we're launching a new product or there's a big event going on, and so you could advertise alongside it. The far more valuable ad inventory is the closer you can get to enticing a consumer to take a purchasing decision or a behavior of some sort, and that's where Meta was going to bring their treasure trove of kind of their ad targeting platform and consumer data.
So, Mark, one of the challenges they talked about in their last earnings call was there was a lot of traction with Reels, but challenges with regard to monetizing Reels. What are the features that you would want to see on this new platform in terms of addressing that as a potential issue?
So I actually think this will have few, and this is all hypothetical or theoretical, I guess, but I actually think this would have fewer monetization issues than what Reels does. Because remember what Reels does is if you think about the average minute that you'd spend on Instagram scrolling away, maybe you see 10 to 12 different posts and you could put an ad every 2 to 3 posts. And so remember the way Meta makes money is that they're taking a guess to try to figure out what you might be interested in. So the number of ads I can show you becomes really critical to how they monetize. When I'm watching a video, maybe I'm watching 2, maybe 3, Reels in any given minute. And so if I show you one ad, the number of at-bats I get to guess correctly is far more challenged. Whereas I think the Threads format is a very similar scrolling format where I could show you an ad every couple posts. And so I think it's actually far more similar to kind of the classic newsfeed model than it is the video model.
Does Threads make Meta's advertising engine or even advertising opportunity any more or less valuable ahead of the 2024 general elections, considering the actions that Meta has taken in the past to try and combat misinformation, even curbing the amount of or any types of specific advertising from officials who were seeking any type of office?
Yeah, so I guess, if I were to kind of break that question into two, the one about the election, I think it's too early to tell if they're even going to have ads on the platform by then. Kind of over the next year and a half. Because remember, the first step is it's all about engagement growth. And you don't want to be putting ads while you're trying to grow engagement because they don't necessarily kind of enhance the experience, especially at the start. So what you really want to do is kind of hit this exit velocity of engagement before you ever consider kind of inserting advertisement into it. But do I think it enhances their kind of advertisement offering to advertisers? Absolutely. They've got a product called Advantage Plus, which is effectively, an automation tool to help the advertiser figure out which ad to show which consumer, where and when. The more you have where available and the more options you have to touch them at different points in time, if they're spending more time within your ecosystem, the better it is for the advertiser.
All right. Mark Shmulik, Bernstein Internet Research Analyst. Thank you so much for joining us this morning.
Thank you so much.
All right. Last week, the Supreme Court made a number of decisions, one of which was to reject the President Biden's student loan forgiveness plan. Now, according to the U.S. Department of Education, $1.7 trillion are owed to the government in federally backed student loans. Now, the government is willing to institute a 12-month on-ramp repayment system, which will protect borrowers who miss payments from being considered delinquent. Joining us now is Yahoo Finance's Rhonda Lee to tell us more about what's next for the millions that owe money. Rhonda?
Okay, so most borrowers understood that it was going to be a 2020 situation, with the Supreme Court. And after everything with Roe v. Wade, borrowers were kind of not surprised, but just hoping that maybe this time around the Supreme Court would give them something. But I think most of them went in understanding, particularly after the affirmative action decision, that it was a no-go. So as we've been telling borrowers from the beginning, 1, go to the federal student aid site, studentaid.gov, update your information. It's important to do that because 1, student loan service providers have changed, and about half of borrowers have a new loan service provider. Go to the studentaid.gov site, update your information, make sure that you find out who your new loan service provider is and what your expected monthly payment is going to be. This also helps avoid scams. The other thing is, for borrowers who are currently in default, the government has a program called the Fresh Start Program that helps borrowers get out of delinquency and come current. Doing that will make them eligible for this new income-driven revised payment plan that President Biden mentioned. The other thing is understand that although we didn't get the up to 20,000, there is this one-time payment adjustment for people enrolled in an income-driven repayment plan. So there is some consolation for borrowers, but like I said, the best thing is to stay ahead of this, go to the website, enroll, find out who your provider is, get on an income-driven repayment plan, and in this high inflationary economy, keep your fingers crossed for better times.
All right, got my fingers crossed out here, Rhonda. Thank you so much for that report. Appreciate it. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Mike Wilson is talking about a wall of worry for stocks. What's on your wall of worry?
I certainly think that if inflation does not come down to the extent that many investors expect, and the Fed has to raise rates more than the 2-ish times that is probably expected, that is certainly a wall of worry. Like that they have to go 4 or 5 more times. That concerns me a lot, and the ramifications of that on the economy.
We've got some great interviews on tap all day here at Yahoo Finance. From finance to football, we'll share our interview with NFL Hall of Famer Troy Aikman on everything from his latest business venture to the upcoming NFL season. Stick with us there.
Plus, a big e-commerce holiday is right around the corner, what some call Black Friday in July. Everything you need to know about Amazon's Prime Day coming up in the next hour.
And stay tuned for our Jobs Day special beginning at 8:25 a.m. Eastern Time tomorrow morning. We'll bring you those breaking June jobs numbers. You don't want to miss it. Let's do a final check of the markets here as we are almost 90 minutes into trade on the day. It's not looking great, so we won't linger here long. Dow Jones Industrial Average, though, that's down by about 1.4%. S&P 500, you're seeing that down by about 1.3%. And the tech-heavy Nasdaq lower by 1.5% right now. Michelle Akufo has you for the next hour of trading. Keep it tuned into Yahoo Finance.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Michelle Akufo. Here's a look at what I'm watching this morning. Tesla joins China's auto giants in a pledge to pump the brakes on EV price wars that have overtaken the industry this year. But is the competition really over? We'll discuss. And from finance to football, we'll share our conversation with NFL Hall of Famer Troy Aikman on the latest business venture that he's brewing up. Plus, everyone's favorite e-commerce holiday is right around the corner. But is there more to the story than yet another record-breaking year ahead? Everything you need to know about Amazon's Prime Day. But first, let's get you a check of the markets here an hour and a half into the trading day. We're seeing all three major indices currently at session lows after that strong ADP data showed that the Fed could still do more work here and the economy is still resilient. The Dow now off more than 480 points, about 1.4%. The S&P also selling off. They're down about 58 points or 1.3%. Especially we're seeing energy and materials, the hardest hit sectors, but all 11 in the red. Tech-heavy Nasdaq, they're also off more than 200 points or 1.5%. Let's also check in on the Treasury market. We see the 10-year now currently above 4% here. The 5-year is actually seeing highs that we haven't seen since 2007. And taking a look at the longer-term 30-year yield, that's up about 1.4%. Well, the Fed's minutes from the June FOMC meeting show that the debate over whether to hike rates again or hold them steady was more intense than investors thought. Now, the probability of further tightening at the July meeting seems almost certain, with 95% of analysts forecasting a 25 basis point hike, according to the CME FedWatch tool. Our next guest sees a hike in July, with the Fed holding steady before cutting rates in the first quarter of 2024. But with new employment data showing resilience in the labor market, could the Fed go even higher? Well, joining us now is Sam Stovall, CFRA Research Chief Investment Strategist. Good to see you again, Sam. So I want to get your take on these numbers. On these ADP numbers, do you think this changes the trajectory for the Fed at this point?
Well, I think you're absolutely right that the Fed will be raising rates in July, and certainly, the stronger the data become, the greater the possibility that the Fed will go beyond raising rates in just July. Next week, obviously, we've got CPI, PPI data, so these inflation measures will either douse or fan the flames of concern regarding the upcoming and future Fed meetings. So right now, we're sticking with the forecast of a July hike, but then a pause, but obviously we are just as data dependent as the Fed.
And I mean, we got this unanimous decision to pause here, but then as we sort of dig into the minutes here, we see that there was a lot of disagreement behind the scenes. What do you think investors should take from that?
Well, I think what you take is that there wasn't a unanimous feeling, if you will, that the hawks really wanted a rate hike. The doves wanted a pause. In a sense, they opted for the dovish side, which means that they'll be giving it to the hawkish side in the July meeting. The real question is, will the data support additional hikes through the third quarter and possibly even further? So I think it all just depends upon how strong the employment data are for Friday. Our expectation is that it will come in around the 250,000 level, as well as whether we see a continued downstep in inflation readings in the coming week.
And so then for people who are wondering, as we're sort of getting ready, we've got the first half of the year behind us, going into the second year, potentially what this could mean for earnings, as we still see this uncertainty about how the Fed is going to proceed. What are your expectations?
Well, the expectations are not good for this second quarter. The bar is set very, very low, with 8 of the 11 sectors expected to post year-on-year declines. And right now, the S&P is expected to show an 8.4% shortfall from the same period last year. However, this is likely to be the trough quarter in this earnings recession. So investors could be, sort of repositioning themselves before the start of the earnings reporting period next week. Also, remember that expectations were for a pretty dismal first quarter, only to end up with a minus 1.2%. So investors were heartened by that. So I think we'll have to wait and see. But investors are more forward looking. So even though we also tend to see the markets decline in the third quarter, we could be setting ourselves up for a nice end of year rally.
And so what are some of the risks that you think are already priced in and some that investors really should be aware of in the back half of the year?
Well, when you look at a variety of historical measures, whether it's a 6.5% gain in CPI on a year-over-year basis, whether it's leading economic indicators in the red, or an earnings recession, an inverted yield curve, et cetera, they have traditionally pointed to a recession. But the recession just seems to be absent without leave at this point. And so investors are wondering, maybe it will get deferred until 2024. The real question then is, does this bull market fizzle out before recouping all that it lost in the prior bear market decline? We don't think so. We think that based on the 20% advance plus the more than 70% recovery of the prior bear market, that chances are we will recover its entirety. But then the question is, does this become a sort of short bull market because of a recession occurring next year rather than the expectation for this year?
So then, Sam, what sort of what sectors look attractive to you right now, and which ones are you steering clear of with that in mind?
Well, first off, we are not very short-term traders, so we're not going to be saying load up on the defensive sectors for the next 2 weeks and then rotate back into the more cyclical and growth areas. Our belief still is that the Fed is close to the end of its rate tightening program. Inflation will continue its downward stair step, and that the market does tend to recover nicely during that pause period for the Fed. So we have overweight recommendations, meaning over the longer term, for communication services, consumer discretionary, and tech, but we have underweight recommendations on consumer staples and healthcare.
We'll certainly be keeping an eye on all those sectors. Always good to have you on. Sam Stovall there, CFRA Research Chief Investment Strategist. Great to have you on Yahoo Finance.
Thank you.
Well, China's EV pricing war might be coming to an end. Now, Tesla joined some of the nation's top automakers in signing a pledge to keep competition fair and avoid, quote, abnormal pricing. Joining us now to break this down is Yahoo Finance reporter Pras Subramanian. Hey, Pras.
Hey, how's it going, Rochelle? You know, you mentioned that pact, or whatever you want to call it. Some say it's a cooperation. In this country, you might call it something of antitrust behavior, things like that. But in China, that's sort of how you do business there. So Tesla, along with 15 other Chinese EV makers, signed a pact today to cooperate to rein in prices. This is at a signing ceremony today on Thursday, kind of led by the CPCA, the China Passenger Car Association there, ending the price war there in China, which was already sort of dissipating, as we saw recently, with some companies actually hiking prices just a little bit after all those huge downward revisions. It's all very strange, I think, for Americans to see that, but that's just how things are done in China. But it also may sort of signal a change with Tesla. Usually the company sort of went by the beat of its own drum and would kind of do its own thing, whether it's a bespoke charging network or, you know, direct sales to consumers in the US. But now you see a more mature Tesla working with competitors in China, opening up its charging network here in the US to other competitors, maybe kind of as the company matures and sees sort of its place in the industry.
And it's interesting because, you know, obviously Tesla is very uniquely positioned to be able to sort of have this very flexible price changing structure here. So can we expect then some normalcy from here? Is this going to be what it is from now, given this pact that they have in place?
I think in China, it shows their willingness to really play ball with what the government wants them to do. And if that means not cutting prices in anger, remember, a lot of customers were angry with them because they cut prices so drastically in the beginning of the year. And many people had paid thousands of dollars more just the day before the price cut. So I think the Chinese are also looking at Tesla saying, hey, why don't you be a bit more moderate here, work with the other competitors in the space, make sure everyone sort of survives and not everyone's kind of racing to the bottom and losing profit share.
I have to see how that competition heats up, especially since there are some more affordable models in that home territory in China. A big thank you there for getting us up to speed, our Pras Subramanian. All right, well, speaking of cars, I'm watching shares of Polestar, the EV maker, popping today after reporting record second quarter deliveries. Polestar delivered about 15,800 vehicles in its second quarter. That's up 31% from Q1. In all, the EV maker has delivered around 27,900 vehicles in the first half of 2023, putting the company on track to reach its 60,000 to 70,000 vehicle delivery goal this year. Now, this comes just a week after Polestar joined the wave of automakers agreeing to adapt to Tesla's North American charging standard. New Polestar vehicles sold in North America will have the Tesla-designed plug starting in 2025. Meanwhile, Polestar is set to start deliveries of its new Polestar 2 this August. All right, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Not enough people are focusing on the fact that things are getting significantly better than where they were with regards to inflation and with regards to policy tightening. Inflation is actually going to be very close to the central bank's comfort level fairly soon. And that's a far cry from where we were a year ago. And that sets the stage for the Fed to end the tightening cycle, which typically creates nice conditions for markets over the subsequent years.
A big price tag even for Big Pharma. Novo Nordisk spent more than $11 million on wooing prescribers to promote popular weight loss drugs like Ozempic. Yahoo Finance's Anjali Kemlani has been covering the latest, and she joins me now with an update. Anjali, what's the latest?
That's right, Rochelle. We know that, of course, pharma has been known for their lobbying tactics over the years, but this is just another example. Novo Nordisk spending $11 million on food and travel for doctors, specifically to discuss Ozempic, its potential blockbuster here for weight loss and type 2 diabetes. One of the things to remember is that this is not the first time that we've heard such numbers. Over the years, companies have spent tens of millions of dollars doing the same. In particular, Novo Nordisk has been pushing the idea of obesity as a chronic disease, lobbying Congress for the past decade or so. It has spent more than $5 million just last year alone, and continually sponsored or had some say, rather, on the Treatment for Obesity Act. And so this is just the latest example of that. They've also hosted a number of policy events in a number of states, and bills have been introduced in many of these states, almost all 50 alone. And that's according to some of the reporting that we've done here at Yahoo Finance. And of course, Stat News out with that 11 million. So all told, just shining a light on what we see happening in the pharma space. The Affordable Care Act basically established a provision to ensure that this kind of activity and these relationships do have some transparency. And so this information does largely come from the Centers for Medicare and Medicaid Services. Now, Novo Nordisk, of course, has a lot on the line here. They are the market leader for GLP-1 drugs. Those are the latest drugs like Wegovy and Ozempic. They treat type 2 diabetes largely and have recently been also approved for weight loss. And we know that there's competition coming down the line. Even though GLP-1s are a class of drugs that are not new, the latest versions of them, latest formulas are really seeing competition, like from Eli Lilly's Mounjaro and Pfizer as well with its oral version. So a lot coming up in the market and a lot on the line for Novo Nordisk to ensure that doctors are aware of their products, even though we all know the latest celebrity trends have really taken care of that.
I mean, it's true. It's all over social media. It's always something that we see now on a lot of these Google searches. And I mean, US drug maker Moderna also just struck a massive deal overseas. What's the latest with them?
That's right. Moderna inked a deal with China, or at least announced a relationship to invest more than $1 billion. And that's the latest move for this company. We know it was a small biotech not too long ago, but it really is following a trend of what other big pharma already know. China is a strong market. Anything that happens over there often hits their bottom line. Their earnings calls and earnings reports, you can see that impact on a quarterly basis. Now, Moderna specifically is going to be focusing on developing their key mRNA product pipeline, and that's something that has been unique. To date, China has only had a relationship with Pfizer for any products as well from the pandemic, but this really signifies a new class of medicines. Now, in a quote, in a statement to us, Moderna said, quote, "Any medicines produced under this agreement will be exclusively for China, so it's not going to be exported. This is not just another part of the pipeline. It will feed directly into China's medicine." And this is something that China has been focusing on, recently, of course, with the tensions. We know Janet Yellen, of course, just stepping down in Beijing, trying to rekindle the relationship that has been tense since the pandemic. China also saying just a day before that they are looking to expand and open the door for a foreign pharma. Like I mentioned, they already have these relationships, but the big biotech boom that we saw in recent years, spurred by the pandemic in particular, we know that they focused inwardly on their products, has really helped, spur this idea that they should be opening the doors. They are opening their doors. And so we'll just have to see how many others are going to be coming along. We know that, for example, other large pharma companies have taken visits to China in recent months and have come back pretty excited about what they see as the local market, which shifts away from what has been just an active ingredient market or generic copycat market over the years.
Certainly a huge serviceable market there, second biggest economy in the world. A big thank you there to our very own Anjali Kemlani. Well, artificial intelligence is revolutionizing the way that companies process and store data. But using AI services could mean handing over swaths of information to a third party. With that in mind, don't let AI steal your company's data, one tech CEO warns. Instead, bring AI in-house to keep the information secure. Matt Culkin is the CEO and founder of Appian, a software company that automates business processes. He joins me now. Good to have you on the show here. So, Matt, talk about this, because obviously when ChatGPT first came on the scene, everyone's sort of jumping on top of it. You have, students, you have employees trying to figure out ways to make it part of their workflow. But what does this mean then for some of these companies and their information that they're essentially handing over to Microsoft?
Look, ChatGPT is amazing and everybody wants to use it. As you point out, students, businesses, everybody wants to use it. But the thing we've got to realize is that whenever a business uses artificial intelligence, before it gets a great feedback, it's got to first offer its own data. So you're sharing your own corporate information. And we all understand that corporate information is one of the most valuable assets an organization can have. And so you've got to be comfortable with sharing whatever it is that you want a response on with ChatGPT or with some other public AI algorithm. And if you're not comfortable, then you need to find another way to use AI.
And so when you say the future of AI is private, what will that start looking like?
Well, public AI is when you send your information over the internet to ChatGPT or a generative AI similar to that, and you get back a response. Private AI is a form of AI that defends your data. It means training your own algorithm inside the business so that you're sharing data with yourself. And no other business, and certainly not your competitor, gets the benefit of the algorithm that you trained. That's what we help facilitate at Appian, actually. We sell AI to businesses, specifically focusing on private AI. So private AI is a lot easier than you might imagine. You need to download a publicly available AI product from a marketplace like Hugging Face, and then you need to train it internally just by gathering your own data and training the new algorithm. It's effective, it's fast, it's very simple, and most importantly, it's private.
And so then for people, perhaps if you're a small business and you're wondering how expensive is it to try and, come up with your own private AI, if you like the results that you've seen with ChatGPT, but now you're like, well, how do I afford to do this in-house?
I think that in the next few quarters, you're going to see this trail get very simple. Right now, we're all coming to grips with how powerful and extraordinary AI can be. And the demand that's going to drive will drive creativity, and it's going to become exceptionally simple to use AI in either a public or a private context. I bet that in the long run, private AI is actually more popular. I compare it to a custom software application. Every business has lots of those. Custom software applications are a typical tool that allow a business to stay autonomous and unique relative to their competitors, to enable unique behaviors. I think we're going to be using private AI algorithms all over the place to do a similar thing.
And I want to ask you about some of these lawsuits. I mean, I knew when I started seeing sort of AI-trained music and artists, I was like, oh, obviously this isn't going to go very well. And then we have this class action complaint in a San Francisco court last week from two authors saying that OpenAI alleging that they ingested their books to train their AI models. What sort of slippery slope does this open up when you do have something like this, scraping these other sources for data without really knowing where it's coming from? You're just sort of sitting at your own computer.
I think these authors have a very good point. We'll see how the law shakes out, but we need to understand how AI really works. AI takes information, and it doesn't so much create content as it predicts content, which is to say, based on what it's read, it's predicting what's the next word, what's the next note, what's the next pixel. It's just a predictor, and it's nothing without the data. It's just reconstituting the data in response to your question. And as such, you could make the argument that all the value in AI is dependent upon the data. And therefore, fair use might not include training your algorithm on someone else's data and creating a new product. I believe that if the law turns out the way I anticipate, the biggest winners in the AI revolution will actually be those who own data, not those who own AI.
And Matt, just very quickly, because obviously when we go into an election year, a lot of people are wondering, what does this mean if I'm getting, AI calls that can perhaps create misinformation. What do you think regulators should do as they see whether it's public or private, and you're not really sure what some of these private companies also might be doing as they're training their AI?
Yeah, that's right. AI is going to be another source of mischievous nonsense in the public sphere. They won't be the first source. There's plenty of people who do this already. You know, there's trolls, there's manipulation, there's all sorts of sources of falsehood. And I think that we've just got to understand that we live in a world where plenty of falsehood exists, and train people to be their own best filter. I would sooner trust a person to be a filter than I would trust the government to be a filter, though I would appreciate some sort of rule that allowed us to identify AI-driven content. I think that would be constructive so that people could differentiate from what the source is of the content they are understanding.
It certainly helps you. You need to be able to make an informed choice, but you can't do that if you can't tell what's real and what's not. A big thank you there to Matt Colkin, CEO and founder of Appian. Appreciate you joining us this morning.
Thanks, Rochelle.
All right, all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Are we going to see a recession this year?
Ooh. Good question. Comes up a lot. I'm going to say for 2023, not likely. 2024, more likely.
I'm going to say that we will know if there was a recession this year after the NBER declares that there was a recession that we entered into this year, which will likely come well after the fact.
Fair enough.
A UPS driver strike is looming after labour negotiations collapsed on Wednesday. The negotiations stalled on new labour contracts, and the slowdown of talks is raising the risk that more than 300,000 package delivery drivers and sorters will go on strike early next month. So what's at stake? Joining us now is Yahoo Finance's Alexis Keenan to give us the details. Hey, Alexis.
Hi, Rochelle. Yeah, so according to UPS, these fractured negotiations with the Teamsters union that represents these workers over this new collective bargaining agreement that would be good for 5 years, they say it's a threat to the entire U.S. economy. Now, the company's union workers, they include those who sort and deliver packages. And as you mentioned, 300,000+ of these workers have already authorize a strike if there's no contract by the deadline of July 31st. Now, I've been trying to get my arms around both the potential for a strike as well as the impact of these 40,000 workers not doing their jobs. Now, as for the economy and the supply chain concerns, UPS handles a total of 18.7 million domestic packages each day and 24.3 million package on a global basis. And in 2022, those numbers really dominated the parcel delivery market by revenue as well as market share. The company held 37% market share in that year compared to FedEx with 33%. Followed by UPS at 16% and Amazon Logistics at 12%. Now, as for the weight of the union's threat of a strike, it's worth looking at the union's labor dispute that's been ongoing with the U.S.'s third largest trucking company, and that's Yellow. And the company's been looking to modify its collective bargaining agreement with 22,000 workers. So a lot fewer workers there, a smaller company. But its management in June had said that it could be out of money by August, and that's why they were looking to renegotiate their contracts, looking at a possible need to file bankruptcy there. But take a listen to how the Teamsters General President Sean O'Brien responded to that threat coming from Yellow.
It is not left at the Teamsters to save this company. We have given enough. What happens next is out of our control.
So O'Brien seemingly willing to jeopardize at least 22,000 union jobs there. And while Yellow is a smaller company than UPS with many fewer workers, it may be kind of a telltale sign of how unions have gained some power in these last few years and the uptick in union activity during the COVID-19 pandemic that seems to have carried forward to today. Also looking at a tight labor market here as we speak, that could give union possibly an edge here. But as of now, these negotiations are stalled, both sides saying that each other has walked away from the bargaining table, and shares deteriorating on that news on Wednesday and still have not popped back up since their close on Monday was at about $183 a share, now hovering around 177 I last checked.
Well, certainly. Thank you for getting us up to speed on that. I know you'll be following that story for us. Our very own Alexis Keenan there. Well, 2023 has been the year for active ETFs. According to Verify, US-listed ETFs saw a net inflow of just over $200 billion in the first half of 2023. But fixed income ETFs punched even higher above their weight, gathering 49% of new money during the first 6 months of the year. As part of the ETF report brought to you by Invesco QQQ, let's bring in Verify Head of Research Todd Rosenbluth to discuss more. Good to see you, Todd. So, break this down for us in terms of this inflow that we've seen into fixed income. Who have been the big winners in that space?
Well, we've seen a lot of money move into fixed income because of the uncertainty in the interest rate environment, uncertainty related to the economy. iShares has been a big beneficiary of that. They've got the large, or the most popular of the ETFs, TLT, which is a 20-year Treasury ETF. We've seen inflows into Vanguard's ETF, which is BND, Vanguard Total Bond Market ETF. We've also seen strong adoption towards actively managed fixed income ETFs that you touched on earlier. Firms like Capital Group, Fidelity, those have all recently or had success in gathering fixed income ETF assets that are core strategies that are intended to outperform the broader marketplace. But there's a lot of money still to be moved in. There's a lot of money still sitting in money market accounts And we at VettaFi think we're going to see a rotation into active fixed income ETFs and fixed income ETFs in general, so much so that we're having a fixed income ETF symposium on July 24th that's virtual that people can register for at etftrends.com. We really think this is the year of fixed income ETFs.
And what do you think is going to be that tipping point then into actively managed ETFs taking more dominance?
Well, we're seeing it so far with active equity ETFs. They are really strong this year. We've seen strong inflows into covered call strategies like JEPI, which is equity premium income. We think that as investors are getting more comfortable with fixed income ETFs, they're going to gravitate towards active ETFs. Investors tend to prefer to run their own equity strategies using an index-based approach, typically with the S&P 500 or the Russell 2000 X exposure, but they lean on active managers to help them navigate the interest rate environment. We've got a big Fed meeting coming up at the end of July that's taking place the same week as the event that we're having at VettaFi. And we really think that investors are trying to figure out how to navigate that. Actively managed ETFs can help investors because they make the decision-making put in the hands of professionals instead of just having investors and end clients try to do that themselves.
And is there a risk that some of these fixed income ETFs would be due for a correction, especially as we're not sure what the Fed will do as they're very data dependent?
Right. Well, we've seen investors they started off the year focused on short-term and treasury-oriented ETFs, those less interest rate sensitive, higher quality strategies. We've seen a rotation into some of the higher risk investments, high yield or going out the curve and taking on long-term exposure. I mentioned TLT being very popular. If the Fed continues to raise interest rates, that will be a negative towards those riskier assets. TLT is very interest rate sensitive and will lose money if the Fed continues to raise interest rates. Whereas an actively managed ETF, I see we're showing BOND from PIMCO and MUSI, which is a American Century ETF. Those are actively managed where the managers can shift towards a lower interest rate sensitive approach if they feel that the uncertainty is greater, or they can, of course, read the tea leaves and rotate towards more active, more higher yielding strategies, high yield investment grade corporates, loans in order to get more income for investors.
And Todd, I know that obviously fixed income, a big one here. What are the other heavyweight ETFs that people should have on their radar?
Well, we are focusing on the equity strategies as well. One of the more popular ETFs this year is QUAL. This is an iShares ETF. It's qual is how I would pronounce it. Higher quality blue chip companies with strong balance sheets, consistent earnings records. It has technology exposure, which has helped it this year, a nice heavyweight 25% plus in assets, but also owns blue chip companies in other sectors. It owns Nike, for example. It owns ConocoPhillips in the energy sector. So a more broadly diversified, higher quality way of getting exposure to the S&P 500. That's been popular with investors this year. They're looking to take a little of that risk off with cash flow, high quality strategies.
Well, great stuff there. Appreciate you joining us with your insights as always. Todd Rosenbluth, VettaFi Head of Research. Thanks so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
The jobs market's going to continue to slow, and that's good news, paradoxically. I mean, the Federal Reserve is trying to engineer a soft landing. We're seeing leading indicators for the job markets weaken, which suggests that the job growth in this country is going to moderate.
The job market showed some surprising strength in the month of June. Companies in the US added nearly 500,000 jobs last month. That's the most in over a year, according to data from ADP Research Institute. For more on the labour market, we're joined by Jill Malandrino, Nasdaq Global Markets reporter. Good to see you, Jill.
Good to see you as well, Rochelle. And June ADP payrolls, to your point, blew away expectations, coming in at nearly 500,000 versus an estimate of 220,000. And this is despite more than a year's worth of Federal Reserve interest rate increases. Leisure and hospitality led with just over 230,000 new hires, followed by construction with 97,000 and trade, transportation, and utilities at 90,000. Now, ADP chief economist Nella Richardson said consumer-facing service industries had a strong June, aligning to push job creation higher than expected. But wage growth continues to ebb in these same industries, and hiring likely is cresting after a late cycle surge. Challenger Gray and Christmas data shows the same trend as ADP, showing U.S.-based employers announced just about 41,000 job cuts in June, down 49% from nearly 81,000 last year and up 25% from a year ago, marking the lowest level since October 2022. Now, it's important to note, Rochelle, that June is historically the slowest month on average for layoff announcements. Technology companies continue to lead job cut announcements with just about 142,000 layoffs in the first half of the year, compared with about 6,000 in the same period last year. The sector laid off nearly 5,000 employees in June, according to Challenger data. Now, the overall labor sector appeared strong in 2022 and into 2023, but the tech sector layoffs tend to be the most visible because the tech giants have many employees. A small percentage of layoffs still translates to thousands of people losing their jobs. And there are several factors that contributed to tech layoffs, including the economy, inflation, higher interest rates, overhiring during that COVID-19 pandemic job correction. So it really had to correct itself back to pre-pandemic levels.
And Jill, as you mentioned there, some nuance to keep in mind with these job cut announcements overall tending to be less of them. But could that be hiding then what's actually going on? Could there still be more job cuts ahead?
I mean, there certainly could be more job cuts ahead because we're sort of in an unknown period at this point. Interest rates continue to go higher, and we're seeing that in the market reaction this afternoon because it signals with the jobs data coming in so strong that there is the potential. I mean, we're paused right now, but for additional rate hikes to get the economy to cool down. I mean, the job market is just, I mean, it nearly doubled expectations with that ADP number and with the Challenger data coming in, better than expected as well. It signals that the economy is still running hot.
Exactly. So the Fed can still do a little more work here and not be as worried about the economy. And Jill, I want to hone in on the hospitality industry for a second. It seems that restaurant workers are taking longer to come back to work in a post-COVID era. What is happening right now?
Yeah, and anecdotally, we see it everywhere. So when the COVID-19 pandemic began, many businesses in retail, trade, accommodation, food service, arts and entertainment, and recreation closed, with the most significant impacts affecting the restaurant, retail, and recreation sectors known as RRR. Now, while communities across the nation felt the impacts of the pandemic on their RRR sectors, New York City, where you and I are based, was hit especially hard with job and wage losses, generally outpacing those in the rest of New York State and the nation at the onset of the pandemic, and that's according to the Office of the New York State Comptroller. The restaurant labor shortage is still one of the industry's biggest challenges. Even 3 years after the start of the pandemic, the labor market has shown signs of improvement, but most restaurant operators are still looking for restaurant staff. More than 87% say they're likely to hire in 2023 if they can find qualified applicants, according to the National Restaurant Association. Now, according to OpenTable, where we make our reservations, during lockdown, many restaurant workers realized their demanding, fast-paced jobs had taken a toll on their physical and mental health. Enhanced unemployment benefits gave them time to reflect on how they might re-enter the workforce, and many workers found jobs in other industries offering more stability or benefits like health insurance. Some turned to gig work or self-employment for autonomy and flexibilities. Others got job training or education and started new careers in fields like teaching or logistics. Of those who returned to the restaurant industry, some left again due to pandemic-era challenges like staff shortages, reduced hours, and lower tips. So restaurant industry continues to struggle.
Yes, going through a lot of changes there. We'll see how that all shakes out. Thank you for getting us those updates, Jill Malandrino, there for us at the Nasdaq. All right, well, from the field to the booth, Pro Football Hall of Famer and former Dallas Cowboys quarterback Troy Aikman has made a name for himself in the sports world. The NFL legend has his sights on a new business venture, though, brewing beer. Aikman, the co-founder of 8 Brewing, sat down with Yahoo Finance executive editor Brian Sozzi to discuss the company's successful launch last year, plans for expansion, and the beer industry's culture wars. Let's listen.
It's been a hectic year and a half for sure, but a lot of really good things have happened. Last year, of course, when we launched, we had some projections. We surpassed all of those. We hit some real milestones for us. We sold over 100,000 cases. As you know, we're only in the state of Texas. And for an independent launch, we were the #1 in the history of the state. So a lot of things to build on here as we move into year 2, and we continue to work and traverse the state. And a lot of good things are happening. So excited about it.
I'm a bit of a foodie, and I think I told you at the time, the can is cool. The brand is on the mark. This is something you're backing. I've tasted the beer. It tastes good. When are you getting out of Texas? When is that big expansion plan for this?
We've got a lot of ground, of course, to cover in the state of Texas. And if we never left Texas, as we said when we launched, we could still have a really viable business. But I expect that as we move into 2024, probably in sometime around the second quarter, I think we'll begin to start venturing outside of the state of Texas. We'll hit some of the neighboring states that seem to make sense. And then we've looked at some other big states across the country as well as to some of those that might be strategic and work well for us.
For those not familiar with the launch, why are you in the beer business right now?
Well, I worked for a distributorship back when I was in college, when I was transferring to UCLA, learned a lot during that summer. And then when I got to Dallas, became friends with one of the big distributors there. I've done a lot with that distributorship over the years. I've always liked beer. A couple of reasons, quite honestly. I'm obviously a lifelong athlete. I'm still very mindful of what I put in my body. And I felt that the beer, what was on the market had gotten a little bit tired, and I felt that it could be done better. So we went to work on it. And I feel that we accomplished that, Brian, because we're 90 calories, 2.6 carbs, but just as important, if not more important, we have no adjuncts. So we had no corn, rice, syrup, or sugars to our beer. And we're the only widely available beer that can say that. So it truly is a better for you beer. And I think it's that has resonated with so many of the consumers that we now have in the state of Texas. And it's the biggest reason why I wanted to be a part of it and make my own beer.
I follow you on Twitter. I have for a long time. So I woke up the other day and I saw the spot from you on your beer, 44 seconds. Maybe you could explain it for those that haven't seen it, because to me, it was, wow, I can't believe Troy Aikman just said all that.
Well, as far as our 4th of July post that we had?
That's correct.
Yeah, so it really, I'm very proud, of course, to be an American, as so many other people are. And when you look at this 4th of July, we're celebrating this great country of ours and the birth of our country. And I know there's a lot of beer brands out there that put an American flag on their package and claim to be American, but they're not. And so I was just basically encouraging those that are partaking and looking for a beer to drink, that if they celebrate the birth of this country and do it with an American-made beer. Certainly 8 is, but there's some others out there as well. And I feel that we've tried to stick to that. We've tried to be very authentic to who and what we are. And that's been pretty much our branding and our messaging throughout, as it is for this 4th of July holiday.
I'm sure you've seen what's been going on with Bud Light. It has been, and the sales continue to get worse. The outrage over what they did continues to worsen. So they are very much in trouble. As a leader of a beer brand yourself, can you ever imagine standing up a marketing program like they did?
Well, our approach, quite honestly, Brian, has always been that we're about the beer. That's what we're focused on most. And we've tried to convey that in every way possible. So I do feel that there are beer drinkers out there who are looking to land on a brand. And if authenticity in a company like 8 that's just focused on making great beer, if that appeals to you or to them, then we certainly welcome you to be a part of Team 8. And that's really been our approach. And how everybody else does it is totally up to them. But we just want to be about making great beer. We don't want to be in the middle of the debate. We just hope that 8's being drank when there is a debate going on. Essentially, that's been our approach from day one, and it will continue to be as long as I'm involved with this company.
All right. Well, of course, we have to talk a little football with you while you're here. Let's start with Aaron Rodgers, new team, Jets. How do you think he's going to do?
Well, I think he's going to do fantastic. I mean, clearly he's a great player. And I think the Jets in general, when you look at where they have been, I like that defense. They've got a lot of good parts. And now with Aaron Rodgers joining that team and 4-time league MVP, I expect the Jets to be right in the middle of it, as does the NFL. We've got a great matchup week 1 on ESPN Monday Night Football with Buffalo traveling to the New York Jets. So for the first opportunity for football fans to get a chance to see Aaron Rodgers as a Jet opening up the regular season on Monday night is pretty special for us.
It can't get any worse for the Jets. As someone who's followed the Jets for a long time, it can't get any worse. It can't.
Well, it's the power of a great quarterback. That you bring him onto the team. It wouldn't have mattered where he went. Immediately, that team then is looked upon as a contender. And like I said, I think there's a lot of good parts around Aaron Rodgers, specifically the way that the defense played a year ago, and a more productive offense is only going to make them even better. So I like the Jets. I would be surprised, and I know a lot of Jets fans would be disappointed if they're not in the conversation late in the year.
Well, if they're not, they might be calling for you, Troy, to come out of retirement, to get out of that broadcast booth and join them. I mean, seriously already. Well, how's that move been for you? Last time we talked to you, I think you were still going through the Fox talks, now on ESPN. How's it been for you?
It's been great. ESPN's been fantastic to myself as well as Joe. We've got a great team. They're on Monday Night Football. The first year was fantastic, and we're especially excited for this year. Like I said, with the schedule that's come out, we've got Philadelphia in a rematch of last year's Super Bowl, traveling to Kansas City midseason. So we've got a lot of really great games. Should be a lot of fun, and I'm super excited about getting the season kicked off.
Well, that was Troy Aikman, co-founder of 8 Brewing, alongside our very own Brian Sozzi. Well, Amazon coming up on its biggest retail event of the year. Prime Day will take place on July 11th and 12th, and though the retail giant has broken records on previous Prime Days, a difficult macroeconomic environment continues to raise questions about how long Amazon can deliver. Yahoo Finance senior tech reporter Ali Garfinkel is here with the details. Hey, Ali.
Hi, Rochelle. So let's be clear about one thing. This Prime Day could absolutely break records, with a catch. Now, I want to start with the numbers because on the face of it, they do look really good. According to estimates from JP Morgan, this Prime Day could drive incremental revenue at Amazon of $5 billion. That is up 13% year over year. Now, the catch. The pandemic boom we saw in e-commerce has sort of cycled back into an e-commerce bust. And now what Amazon has is a difficult macroeconomic environment that they're running headfirst into as they're trying to grow into what JP Morgan expects will be the largest retailer in the United States next year. Now, these macro headwinds really pressuring consumer demand, they do mean that Amazon really has a hill to climb here, but there is still evidence, Rochelle, that they could climb that hill.
I mean, obviously, a lot has changed since Amazon first launched as a so-called, bookstore killer. But how has Amazon's supply chain evolved in recent years, and how might that affect this Prime Day?
So the supply chain has really evolved in recent years because of the pandemic. During that pandemic, we really saw Amazon just rushing to get things to customers however they possibly could. Someone would send, a mini fridge, say from Seattle to Florida, for example, when in reality, the idea would be that it's actually in Florida. The reality is this, Rochelle. Amazon is on track for its fastest Prime Day ever because of changes it has made since the pandemic, and definitely changes it's made since being a bookstore killer. So those times during the pandemic, there were all sorts of problems with optimizing inventory. Now, what does that practically mean? One Amazon executive I've spoken to previously was telling me that they had snowblowers in Miami and they had Kansas City Chiefs hats in Las Vegas. And those things, while they in theory could be there, it is not the actual best way to do that. So the goal over the last few years has been to really clean that up. And eventually the hope is that translates to faster delivery times. Certainly some analysts expect it will, but the moment of truth will come on Prime Day, Rochelle. Will you and I get our packages faster? That is the question.
And speaking of that, Ali, of course, before we go, have to ask you, what are you going to buy on Amazon's Prime Day?
I'm really on a home theater kick. I just can't stop buying speakers no matter what I do. I bought a subwoofer recently. I bought a sound bar. I'm thinking of getting 2 more speakers for the sides of my TV, and I think that might be the limit for my neighbors.
So I'm trying to think. Either I feel like I'm old because I'm like, oh, I want dishes. I'm like, a carpet steamer. I was like, what's happened? Why am I this person now?
A carpet steamer? Honestly,
why do I not want
to? It's great. A carpet steamer. Honestly, maybe I'll go get a carpet steamer.
Well, we'll have a good sit down. You'll have your speakers going. I'll be over there steaming in the background. We'll make a day of it.
I love it. I think we should do it. Let's do it as soon as possible after Prime Day. What if we get all our stuff fast? That's the cat.
That's true, depending on when we get it. Always great to have you on, our very own Ali Garfinkel. All right, well, before we go, let's get you a final check of the markets as we head into the noon hour here. As we see here, all 3 major indices still in negative territory, slightly off the session lows though, but the Dow now off about 470 points or 1.4%. We have the S&P 500 there also still under pressure, down about 53 points or 1.2%. Tech-heavy Nasdaq there taking the biggest blows, well, about level with the Dow there, down about 188 points, and that's about 1.3%. Well, that'll do it for now, but I will be back with you tomorrow at 11 a.m. Eastern. And of course, don't forget, we have more Yahoo Finance coming up at 3 p.m. Eastern today. So stay with us on Yahoo Finance.